Well, thanks for having me. So what we're going to talk about today are two really great option strategies that are really good for any market environment. But when you get into kind of higher uncertainty type of, markets where you're not sure what the headline is going to be from one day to the next, these can really be some really good go-to strategies because the risk is so reduced by the structure of the trade. So that's what we're going to talk about here today. And again, thank you for being here. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, the real secret to me as far as trading profits comes down to three basic things: direction, timing, and then options for, what I call opportunistic risk management. So all these three components, are going to what are going to lead you to successful trading. So, when we're trading options, they have so many more advantages than just trading outright stocks or even futures. But as you probably know, they can be a bit more complicated as well. But once you understand the benefits and the advantages of using options, and especially option spreads, you're really going to never look back. So when used correctly, using option spreads, what they're going to do for your trading is they're going to give you more defined trading risk. They're actually going to lower your capital at risk that you put up on each and every trade. They're going to provide you greater trading leverage, and they can offer you an unmatched hedging advantage if you use the correct kind of option spreads for your trading. Now, I've been trading options for over 30 years, and I've found that the most valuable go-to option strategies that can literally help any trader more than any other trading strategy known, and especially during extreme market uncertainty when we get in those kind of environments, is to use the option butterfly and the long condor. So I kind of call them my trading secret weapon just because of the structure, and as you're going to see as we move forward here. Now, the huge advantage that these strategies are going to provide you is the unique framework, their structure. They're designed to take advantage of time decay, or theta, and volatility, which are the two main option pricing components. And so this will really help to kind of stack the trading odds more in your favor and can be used in any type of market environment. So, but they really become a favorite go-to when I'm in kind of a higher market uncertainty type of market that we're trading. So if you just know when and how to use them, these are really great strategies to incorporate into your trading. Now, because they're structured to require only a very small amount of your hard-earned capital, your trading returns can be very explosive. It's kind of like what I call lightning in a bottle. When I started out my trading career back on the oil side, I had my first boss. He was a real character, but he would always say if there was a great trade, he said, "Ooh, this is like lightning in a bottle." So sometimes these trades can be that way. So because you put down so little capital and you get such big, explosive, high returns. Now, the butterfly and long condors, they can also be used as hedging when you mess something up. So they can be used as a fast, low-cost way to cover your you-know-what pronto when position starts to move against you. And I've literally found no other, hedging strategy that even comes close to using these into your trading plan. Now, what you can do is you can literally keep your original position open just by either implementing a butterfly or long condor hedge on that original position. So, you've probably been in situations where you thought you had a great trade set up and it was going perfect, and then something happened, there's a news release or whatever, and it stalls it out, and then all of a sudden it loses momentum and you get stopped out. And then a day later or so, or 2 days later, you see it go back up. So it's real frustrating. But once you understand and you can use this kind of hedging technique, you can kind of sit with the trade longer, to let it stabilize. So this kind of hedging strategy, it takes advantage of time decay. So while you're waiting it out, and many times that's all you need, just that little bit more time for that original position to stabilize, move back in the favor of your original trade directionally. And then at that point, you can remove the hedge and let it just run the way it was going, or you might just decide to leave it as that hedge position, which I'll show you some examples. Now, when we look at the butterfly, it's fairly simplistic. So here's an example of a butterfly. So if you looked at let's say a call debit spread, so you do puts or calls, it doesn't matter. But let's say you had a long call here and a short call here, and your total at risk is your debit paid of that call debit spread of $300. Now, if we wanted to adjust this trade, reduce our risk, but stay with it or hedge it, we could easily turn this into a butterfly by selling another vertical spread against it. All right, so in here we've got $300 of risk, but I can reduce that quickly by converting it to or adjusting it to a butterfly. So by selling another vertical call credit spread against this, so if I sold a call here, bought a call here, sharing the same short strike as that debit spread, I bring in $200 credit here, and now I've reduced the original trade from 300 down to 100, and I've converted it to what we call a balanced butterfly. So with this structure, I can then have a lot of flexibility on the trade as to what to do next. I could either leave it as this butterfly structure for only $100 risk, and if it settles out and goes out at expiration inside what we call the profit tent or profit zone, and especially at the top of the zone, top of the tent, you can make a huge return on that lowered capital at risk. Or you can leg out of one side or leg out of the other side, or I can add additional credit spreads to this structure to create what we call ratio butterflies. So it gives us a lot of flexibility and opportunities to adjust and make kind of what I call that opportunistic hedge trading management. Now the other one is the long condor, and I love this strategy because what it does, similar to the butterfly, it will reduce your risk. The other thing about these two strategies, they're a positive theta trade, so you're not going to lose time decay on these, which is another great way for adjusting your trades to get out of that situation where if you're, say, long a call or even a long call or debit spread, you're going to be losing theta each and every day. But these two structures are a positive theta. So this one, though, gives you a bigger, wider zone for profit versus the butterfly, which you really have to thread that needle. Now, the butterfly will give you fabulous returns, but it's a little bit more kind of perfect as far as the thread the needle timing, but this one gives you a wider zone for your profit. So really like this strategy. We use this quite a bit and great for hedging as well. Now the core concept that make the butterfly and long condor dynamic comes down to the option pricing and how it works. So the most important option factor kind of for profit generation using the butterfly and long condor strategy really comes down to you understanding how option pricing works and that concept of time decay or theta and its effect on the price of the option. So that's where we get the big benefit and advantage with these types of trades because of that theta decay that goes in our favor. So let's take a review of this kind of core concept. Now, when we look at theta, it's what tells us how much the option price will go down over time. So that's the rate of time decay of your stock option or your securities option. Now, time decay occurs because of that extrinsic value or that time value of the option going down each and every day. And at expiration, it goes to zero. So it's a decaying kind of component of your asset, the option. So that's what we're going to take advantage of with these two types of option spreads. So again, here's the butterfly construction here on the left, and here's what the condor looks like, and there's very, very similar. I kind of call them the same family as far as your strategies that you can use to take advantage of time decay and also volatility decay. Now here's a kind of a simple view of how they can really be dynamic as far as lowering your risk. So here's, just a simple example, XYZ, let's say it's trading at 45, and we're looking for a target in this example just down to 43. So you can use the butterfly for target, I use them for kind of directional target trades, and you can make them, really low, small targets or bigger, targets. And the time frame, it's good in kind of shorter duration or, 1 or 2 weeks out, something like that. So in this example, let's say you go out and we're targeting 43. We think it's going to go down just, $2. But I could go out, then I could buy. What we want to do is we target that strike here. If you're targeting 43, we're going to make that kind of what we call the body of the butterfly. So we buy that 44 put, pay $238, $2.38 per contract, and then you sell the 43 put against it, bring in $1.67, and you sell another one, $1.67, bringing in that twice, and then you buy the 42 below it, for your protection. So it's a capped risk trade. It's a debit trade cost. So in this example, we've taken this and reduced our risk to $10 per butterfly spread. So $2.38 for the 44 put, $1.06 for the 42 put. Those are debit costs, and then we receive credit of $1.67 twice, times 100 to make it into an option contract equivalent. And so the maximum risk for this particular butterfly spread example would be $10. Now the potential profit, you look at your strike price, you're between the strikes. So you can see it's $1. So 44, 43, 42 is $1 between each strike. All right, so you take that times or minus your cost of your trade, and that gives you your potential profit. All right, so 43 minus 42 minus your cost of the trade. So your theoretical profit is the difference of 90 cents times 100. So theoretically on this trade, if it goes out at expiration right there at 43, you can make $90 per butterfly on $10 risk. That's a 900% return, or risk of you're risking $1 to make 9, positive risk ratio. So that's the really unique structure of the butterfly and how it can help you in a lot of situations. Now you'll never get the exact $90 or exactly perfect on pinning, but just think about it. If you even get close, that's a huge return because the capital at risk is reduced and so low. Now, so that's kind of a simple example of how they can really be a favorite in any kind of market condition. Now let's take a look at the, how to choose the best butterfly or long condor strategy kind of to meet your trading goals. So one major goal of every trader, in my opinion, should be to look to select trades based on what's going to give you or provide you the most consistent positive returns over time and with low defined risk, and not always the greatest return, not always going for the big home run. So I always look at risk first, and then I look at my potential reward to that risk, and that's how I kind of look at trades. So the longer you're in the trading game, the more you're going to probably be aware of risk and kind of look at that first. So one of the best ways to achieve this is then by being aware of what are the different option strategies that are out and available for you to use, understand how they work, and then select the one that's going to be best suited for the market environment you're trading or your trading goals. So everybody here today is going to have a different amount of capital to trade. So, Vanessa might be trading with a $100,000 account and Charlie has a $10,000 account. So you're going to look at different kind of perspectives as far as your goals and your risk tolerance based on that. But the one thing is when you look at a butterfly or condor, you can trade it with any size account. So it can be a one contract account, or you can be a hedge fund trading thousands of contracts. So anybody can do it, and it's a really unique, quick way to trade and set these trades up. Now, when we look at the butterfly, call this kind of the butterfly family. And there's a number of different variations of a butterfly. So we've got what we call just using a long call or put butterfly. We've got what we call a broken wing butterfly. We could use calls or puts. We call what I call the ninja butterfly, which is an unbalanced or ratio butterfly. We have the iron butterfly, and then we have hedging defenses that we can use the butterflies with, and then kind of that cousin of the butterfly, I call it the long condor. So let's take a look at a few of these different trade examples so you can get a better idea how they work. So first, let's take a look at the butterfly. So this is just a really great strategy, very simplistic, but once you understand how, when, and why to use it, it's going to be a really go-to favorite for you. Now, when we look at the butterfly spread, we can adjust the risk and the profit based on what we call the wingspan. So if you were out there, if you're a collector of butterflies or whatever, you've got a little small net, it's going to be hard for you to catch that butterfly. But we can adjust the butterfly in our profit zone by the wingspan. So, if you're trying to catch a butterfly and you've got a bigger net, it's going to be easier. So with the butterfly, we can structure it with either, a really big profit zone with a really wide wing butterfly, or if we really want to narrow down our risk but still have potential for a huge reward, we can narrow the butterfly. So we can do this by the wingspan of the butterfly. So let's start out. I'll show you a narrow wing butterfly and how that works. They're great for ETFs as well. So here's a narrow wing butterfly on the ETF SPY. All right, so this is going to be like a $1 wide spread or a $100 wide spread. So this is a targeted trade. So I like to use butterflies kind of for target trades. So I like to use Fibonacci to establish my price targets and moving averages. So in this example, looking at Fibonacci from this kind of swing high to low, the 618 is always usually a big resistance area initially. and there was a lot of option activity here. That's another thing I like to use in moving average. You can see that moving average. So we were looking at a kind of a target right here, 273, 274, and it was trading right in here about, this 265 level. So we did a targeted butterfly, super low risk with a really narrow wingspan right to that 273 area. So what we did on this trade is we went out and we bought, it was trading here at 267, and we were targeting this 273 based on that fib levels and some other things. So bought the 272, sold the 273. This is our body or target, and then sold the 273 again, bought the 274. So this is a balanced butterfly, capped risk, $1 between the strikes. Okay, so narrow wing butterfly like that. So you can see your potential here is that it's $10 per spread risk. So down here you can see a 10-cent debit cost. So $10 per butterfly. Now the difference is your $100 spread width minus your cost. Theoretically, then you can make $90 per spread or a 900% return. Now 2 days later, this was up $70 per spread. That's a 700% return. So, you hear people say, "Oh, I made 1,000% return" or something. You might think that they're, full of it. But with the butterfly, of all the different option spread strategies, this will give you the highest return on your risk, the way it's set up. So that's, what that looks like going in. So let's take a look at how this ended up. All right, so this was a very short duration as well, set up on for 2-day trade. So you can set these up for 1-day trade, 2-day, or 1 week, 2 weeks, or even further out in time if you want. So you can see here going out at expiration on the 16th here, it went from 10 cents or $10 per butterfly spread and was then trading at 80 cents or $80 per spread. So that's your $70 profit per spread. All right, so that's a 700% return on that risk. So in this example, it's 4 contracts, so that's $280. So that's the thing that really is great. You're getting the benefit of that time decay, which goes to 0, volatility goes to 0, and you're going to get a potentially really high return on your capital at risk. And these are always a positive theta. So if it just churns sideways, you're not losing money on theta decay. So that's what it looks like. And that little bitty black area here is what's left of the price of that time and volatility in that trade. But you can see it was going out right here, pretty close to the top of that profit zone, all right, at 273. So that's an example there of a narrow wing butterfly. Now, these are also sometimes you might hear them called lotto trades because you can literally set these up for like 10 cents and they go to your spread, your total, max peak spread, and you have these potential for huge returns. Now, the next one is the wide wing butterfly. And these are structured also. They're very defined risk, great for hedging. And these are, again, used for what I call targeted directional swing trades. Swing trades being a trade that could be a day to 2 weeks, something like that. They're great for what we call directional pinning trades, where we're looking at a specific strike that we think that the price could go out at a specific strike at expiration. So we can target that. We call that a pinning trade for pinning. They're great for high volatility markets because we can get a really low defined risk. Plus, we're taking advantage of selling volatility with this strategy. Fantastic for really high price stocks like an Amazon, Tesla, those things that are super expensive that most traders are not have enough capital to trade. So we can trade those with the butterfly. Trade duration 1 day to 2 weeks typically. Always going to give you a positive theta. So no time decay on your trade. And returns of 2 times to 10 times or higher based on your capital at risk. So here's an example of a wide wing butterfly that we did on spot. These are also just trades that I do. I have an alert service, and these are trades that were done in the alert service, but this was one that we did on spot. So this is a wide wing butterfly spread width of $1,000. Okay, so let's walk through this trade. So spot was trading right here, right at 257, and we were looking to move. You can see all this moving average resistance. So that's kind of how a lot of times I'll set my targets based on moving average resistance and Fibonacci level. So we have this Fibonacci level here at 265, and you can see all this kind of moving average resistance. So a really good target there. So just a small target 257. It was trading right here. We're targeting up in this area here. So we can make this a pretty low risk trade and a breakout trade for the upside, but we think it's going to probably stop in this area here. So we could take advantage of that with the butterfly to take advantage of that time decay and volatility collapse going into expiration. So that's the kind of the chart setup. Now, so we did a $10 wide butterfly. So what we did was we went out and we bought the 260 call here. Okay, you can see down below. So we went long the 260 call and then sold the 270 call. Okay, so one contract here long, two contracts sold on 270, and then the 280 long that. Okay, so the body of the butterfly is here at 270. We're targeting that 267.70 level. Now you can see here this trade was going out at expiration right here. I mean, we had profit take from when we set this up on the 23rd. I mean, it was up into profit on the 29th, 30th, 1st, and 2nd. So you start taking your profit, scaling out, and on the last day, that is where you have the potential to make the big home run. So here on the at expiration, it was trading out 268. So very, very close to that 270 short strike body. Okay, now look at the theta. This had a positive theta. You're making $96 for this one day. So it's very, very great. So we're taking advantage of that positive theta. So at the end of the day, going out here on expiration, this trade was up $555 per spread. And we started the trade at $1.50 at risk. So $150 per spread. Butterfly was your total risk here. And at the expiration, it was going out up $255 per spread on your risk of 150, so that at 370% return. So again, taking advantage of that time decay, volatility collapse, and a high return on capital at risk. But this was a really fat one, so we had a big profit zone in here. So we were taking profit, all through here from, because it was started trading up in here, and then it kept getting better and better and better. And so what you want to try to do is leave some contracts so you can leave it into the last day to maybe get that big home run hit. So that's what the wide butterfly can do for you in that example. So really big payoff. Now here's the profile of what it would look like, maximum potential profit on your risk. So here you can see that the risk profile of this 260, 270, 280, $10 wide spread, again, $1.50 or 150 at risk. So here's your maximum loss. Here's your debit paid 150. Theoretically, if it went out perfect at expiration at the 270 strike, you would have made $850 per spread, which would be a 566% return. So this one actually came out pretty close, but that's kind of what you're looking at. And that's why I call them kind of the amazing option strategy to use. All right, so that's an example there of the potential payoff. Now, this is a really good example to show you all the other different kind of benefits that you get from it. So here, for example, would be on Amazon, a wide wing butterfly. So think about Amazon. You probably can't trade it because it's so expensive. So Amazon, and this one was also a targeted trade. It was trading right here, been consolidating at this 200-day moving average. And we were looking for a move on this one to this 1830 level, which was a Fibonacci level, some moving average resistance, etc. So at the time it was set up, it was trading here at 1,782, and we were targeting 1830. So one benefit is if you were to want to trade Amazon, and you just all you knew how to do was buy stock, or sell stock. If you had bought Amazon here when it was trading at 1,782, and you did 100 shares to be equivalent to an option contract, you'd be out a pocket $178,200. Now, if it hits your target here of 1830, well, you made $48 per share, but look at your return. It's only 2.69% on over 178,000 risk. That's to me a huge risk. But in this example, you could trade Amazon as a butterfly for $80 per option contract risk. So you could basically control 100 shares using a butterfly for $80. All right, so this was targeting, again, the body here, 1830. So bought the 1820 call, sold the 1830, and then turned around, sold that again, and bought the 1840. So a $10 or $1,000 wide butterfly gives us a big low risk trade, but a big huge zone for profit. All right, so here you can see your $1,000 less 80 is your cost. So theoretically, you can make $920, which would be over 1,000% return. So there you go. You're risking $1 to potentially make 11.5. So that's the real beauty of the butterfly in certain market situations, or when you're trying to trade a really high price stock. So that's a big bonus. Now here are some other big features that are a huge advantage. So this is pretty amazing too. So this is Amazon on the last day on expiration. So this was Friday in the morning. So in the morning, this trade, Amazon, the cost of the trade was 80 cents or $80. Now it had gone up to, it never got to the perfect profit zone, but it's trading right here. Okay, so that's a T+1. That's where it was in time in the morning on expiration day. So, but look, it was up $150 per spread, not bad. So up 150 on that risk of 80. So this was up 187% return. So the potential, though, it could be over 1,000. But this is the really interesting thing. So this is in the morning. Okay, so now 3-4 hours later in the afternoon, this thing is going to be up 6 times more on profit and on return. All right, just within one day. See all that black area? That's what we call what's left of the time that's in that option spread and volatility. So that's a huge chunk of profit still sitting there to potentially be taken. All right, so here it is in the afternoon on the same day, the same butterfly. So here it is. You can see the profit zone here. Now it's trading right there at 1832, but now it's up $614 per spread. That's 4 times more than it was just in the morning. So it went from 80 cents to 695. All right, so $614 profit per spread. So that's a 769% return, and you've increased your profit by 4 times what it was in the morning and 4 times return on your risk. So that's another really fantastic advantage. So you can see there's still a little bit of time left in that trade. So that's what we're taking advantage of, that time going to zero, volatility going to zero, and that's where you can kind of see that example of how that can be a big payoff. So you can see there's still a little bit of theta in there, $33, that could be still sucked out of that trade. So that's a huge advantage there. Now, the next thing I want to show you is kind of how we can use this for hedging. So this is an example of, again, using SPY and converting this or adjusting this to what we call a long put condor. All right, so this is the trade one will say SPY, we did a put debit spread. We were looking for a downside move. And then when it moved down, we got the downside move we were looking for. But instead of just taking the put debit spread and closing it out, we had the opportunity to adjust this put debit spread into a free trade by adding another leg to it and converting to the long put condor. All right, so when you're trading, especially trading options, always think 1 or 2 steps ahead, because a lot of times you'll get these types of opportunities. So going into this trade, we were long the put debit spread, and then always think 1 or 2 steps ahead. So we were thinking, okay, if it gets down to our target level, let's see if we could convert this to either a butterfly or maybe a long condor or put condor. And if we can get back the debit costs that we had in the trade, receive that back by the credit spread, we can adjust this to a free trade, or maybe even into a trade that has a credit. All right, so that's the trade setup. We were trading right about here, this 275 level. All right, and our target was going to be down to this fib level here, the 618, around 270. So the first trade one was just doing a put debit spread, a nice put debit spread here. So bought the 273 put, sold at 270. So it was at the time trade at 275. All right, so nice trade there, very low risk, $65 debit. Now potential for a good profit, 235, which would be over 300% return. But if you've been trading this market, it's been hard to short. So typically, you might get a move down that snaps right back up. So what we have been doing on our shorts is typically we might set up the put debit spread, but then when it gets down to your target, you take partial profit, and then if you can, we look to adjust it to a free trade or maybe even a credit trade. All right, so here it was, it popped down and hit our target on the 29th, and so this was up $98 per spread profit. Not bad, 150% return there. But instead of just closing the whole trade out or sitting on it thinking it could go lower, you take some profit or adjust or do both. And this is the step 2, trade 2 will be the adjustment trade. All right, so in this example here, it dropped down to our target of that 270 level. And at that point in time, we could sell the 268 put short buy the 265 long, which we call a bull put credit spread, and bring in $65 credit. All right, so just remember from trade one, we had a 65 debit cost. Now we're bringing in $65 credit. All right, so now doing that, now we have zero cost in the trade, zero risk. And this is adjusted the trade to what we call a long put condor. All right, so this is the cool thing about these types of trades, the flexibility that they give you. All right, so trade three converted to long put condor. So trade one, we were long the 273 put, short the 270, $65 debit cost. Trade two, when it hit down to our target, we sold the 268 put, went long the 265, bull put credit spread, credit of 65. Now we have zero risk, so you can just kick back, see what happens. Now, if it was to go out right here at expiration between those two short strikes of the spreads, this would have a maximum profit of 300, but we have zero risk. So it's not like you're stressed out, waiting for it to happen. But if it also goes out anywhere in the profit zone, we still have a potential for a big, huge profit. So this was going out right here at not perfect 271, but we were up $164 per spread on zero risk. So trade one made $98, pretty, okay, 150% return, but this made double, almost double, and on zero risk. Now this one, when we did this, this was actually at one point, you could have done a credit on the trade where you actually would have zero, not only zero risk, but you would still make money regardless. So that's the beauty of it here. So if we go back through, you can see that trade one made 98 per spread, or 150% return on just the debit spread. But by adjusting this to a zero risk trade, trade two ended up making 164. But the bigger thing was looking at that risk of $0. So really cool trade set up there that a lot of different ways you can use that to your advantage. Now, if you'd like to learn more how to master these types of really high reward, low risk strategies, I'm going to be doing a live butterfly long condor course here, and I'd like to invite you to it for a really great deal here. So this is going to be August the 28th, and it's going to be a two-part course, about 5-hour course, but it's just going to be strictly on the butterfly and long condor. There's a lot to these trades that I'll show you and teach you in this course. But if you'd like to join us, here's the link. It's going to be, I've got fabulous, fantastic bonuses for you. And to get you started, I'm going to give you the last time I did this course was back in earlier this year, January. And so you're going to get that course to start with on demand, so you can get rolling on it. And then we're going to do the live course not this next Saturday, but Saturday on the 28th of August, 11 a.m. to 3 p.m. Eastern, or however long we need. And everything's recorded, broken in modules, and then we'll finish up on Monday, 6 to 7. So these are all recorded into modules like a chapter of a book, so you'll have these forever. So here's the link, and then I'll go through all the details of the course, and you ask questions if you'd like. So here's the link here, and now everything on this course will be yours forever. So that link should pull up a drop-down payment link here. Yeah, just double check that, make sure it works. And it does, and so you'll see it's, if I can get that for you. Why is it doing that? All right, here we go. Anyway, so use that link there. Here it is one more time. And that will get you the payment link here. So let's go through all the details of the course. So with this, here's a fantastic bonus package. And this, again, it's a one-time $197, that's it. So you're gonna get access to the live course, just all on the butterfly long condor. Then you're going to get to start off with right away. You'll get a special bonus of the course I did last go around 6 months ago, which actually turned out 7 hours. So it's on the butterfly long condor. So you'll get that right away. So if you went to my website, this course is on my website at $497. And then you're going to get, as an additional bonus, what I call, this is a course I just did a month back, Fibonacci price target mapping. This is what we use to, price out and make our targets for profit taker defense. So you'll get this as a free bonus course, and that's on the site, $397. Then you're going to get my new options for beginners course. So even if you're beginning to, just starting out on the option side, this is a really great package, because you'll get all these courses and benefits, but they're yours forever. But you'll be able to, absorb the butterfly long condor because of this kind of beginners course, plus it's yours forever. So you can always go back. So you can kind of put this in your library, and if you're not ready right now, you will be. So it's yours there to go back and forth on. So you'll get that. That's 197 value. And then for additional support, I'm going to give everybody that signs up here today a trial membership to my trading club, which gives you access to my virtual trading room every day. So to give you additional support there for your questions, and also see what trade setups we're looking at, over the course of the week. So you'll get that for 30 days, and you can start this whenever you want. So if you don't want to start it right away, maybe you want to wait till after the course, just let us know and we'll start it whenever you want. But you'll get that for 30 days, and then hopefully you'll stay on with us, and it's 97 a month, or you can do an annual membership for 488. So then you'll get, as additional bonus, we'll do a live follow-up Q&A, support Q&A, and then this will be live and also recorded for you. You're going to also get my option trading tutorials, another course on just options, basically on the Greeks, theta, delta, gamma, all that stuff, plus probabilities. So you'll get that as another free option course. And I'm going to have what I call my option strategy guide. So this is 15 other option type strategies you'll get, plus my power tool guide of the Greeks. You'll get that as you can hand that printed out, put on your desktop. So really great value here of all the different additional benefits. So that's what you're looking at there. Now the course, what we'll do, I always like to start out my option courses with kind of the basics of the Greeks that are kind of vital for that particular option trade or strategy that we're covering in the course. So we'll just go through the Greeks that are important for the butterfly and long condor, show you how the pricing and how those affect these two strategies, the importance of that theta decay, how that impacts the butterfly, the long condor, the importance of volatility and how it impacts, and what we call volatility crush. So not only will you be learning about the butterfly, long condor, but you're going to learn the Greeks of things that are going to help you with any of your option trading in this course. And then how option pricing works, which is important for any of your option trades, based on the effects of that time and volatility. And then Fibonacci. So with any trade setup that I do, I always incorporate what we call that price target mapping using Fibonacci and what we call standard deviation. So you'll learn how that is used for forecasting price for these option trades. So this course gives you a huge amount of things that'll help you in all of your trading. And again, you're going to get that Fibonacci course, which is a target mapping course, 3+ hour there. Now, part 2, then we go into what makes these trades work, and I'll go through every strategy, every variation in the course with examples of how, why, and when would you use a long call or put butterfly? When would you use a call butterfly, or when would you use put butterfly? All right, so very important there. When and how and why would you use the wide wing butterfly, a broken wing butterfly, a ratio butterfly, and then even what we call a broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So it's kind of jokingly bubblegum shrimp. You're going to learn every variation in detail of these different butterfly type setups, and there's going to be one or two that you might really like to use. Okay, so you're going to know the difference between just a balanced butterfly and a broken wing, and then when would you use that, and what situation, what market would you kind of look to do those types of strategies. So this will help you choose, and you'll understand then which one to use if you want, or just keep it real simple. So we'll go through every variation there. In the course, we cover what's the best time frame. Should you go out 1 week, 2 weeks, 3 weeks? How do you capitalize using the butterfly condor on using stocks or ETFs? What should you use? Index options are great, SPX, NDX. How do you get those structures where you can get that 10 to 1? What are you looking for as far as a trade setup, as far as a chart pattern or things like that, and when you would set up a butterfly, either narrow wing or wide wing? How do you get that profit? How does it work, that volatility collapse? What is that? How does that work? And time decay of the butterfly. So you're going to learn everything under the hood of what makes these things work as a strategy, and then you're going to be more confident of actually pulling the trigger and using them once you do understand how they work. Then another thing we'll talk about and cover in the course is what we call option pinning. All right, so this is typically monthly option expiration, which for your information next week will be monthly option expiration, and the big institutions typically will be in the monthly option series. So this is a really fun thing to take advantage of, to look for pinning situations where a strike might go out at expiration on the monthly, and we can then trade that based on using typically a butterfly. So it's kind of gives you 12 times a year for kind of additional income stream there. And so pinning is, we're going to use that price target setup analysis, Fibonacci, option activity, standard deviation of forecast price targets. So you'll learn how to do that in the course. And then what else? Man, this course is one of my, most extensive and best courses. So then we go into the long condor. So what are the major trading advantages of the long condor, to give you these returns of 100, 200, 300 on very, again, low capital at risk and also positive data. So how then and why, when do you use a long condor spread versus a butterfly? So we'll go into detail in the course on that. So then part 3 is hedging. Spend a lot of time, big part of the course will be hedging. Now, this market's been just going straight up typically, but at times you're going to need to understand how to hedge at some point in your trading career. So this will teach you hedging. And then what I start you with is the progression of hedging, what that is. If you just say you go long, stock, how do you hedge that? How do you hedge a call or a put? How do you hedge a spread, etc.? So progressions of hedging. And then how would you then use either a butterfly or a long condor to hedge your core position? So a big part of the course will be on that. And then how would you use a butterfly or a long condor to defend a vertical spread? So let's say you do credit spreads. How many people here do credit spreads and have been just run over and crushed by having to go through your short strike? Do you know how to defend that? Well, this course will show you how to defend a short credit spread that you might have, getting threatened by that short strike getting overrun. So I'll show you how to protect that. And then a step-by-step checklist on when and how to put the butterfly long condor on, execution trade management, and then resources will go through the exchange traded funds to use, what is assignment risk, expiration, auto exercise, what that is and how to look out for it and how to not get hurt by it in your trade. So it's very simple things to do there. So this course covers that. And then you'll get a trading library of other, past butterfly condors that you can go back and learn and see how they work. So it's a very extensive, great course. Do it usually once or just twice a year at the most. So this will be your opportunity if you'd like to join us. This was from Alicia. She said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one is anything like this. Wish I had found you sooner, but I'm glad I found you now. Thanks, Alicia. And this is from Jim. He said, thanks again for showing so many ways of getting out of trouble. Isn't that the truth? Sometimes you get in trouble, right? So these are different strategies that will help you get out of that trouble. Could have come in handy in the past, and my trading P&L would have been totally different, Jim. So here's that link again for you. And there you go. Now, so that's just a little feedback there. Now let's go through the bonuses. Fantastic bonus package here. So you're going to get, to get you rolling right away, is you're going to get the course I did last go around 6-7 months ago, over 6 months ago. Yeah, wow, it's been a lot. This year is flying by. So this is my on-demand recorded course on the butterfly long condor. So it was a 7+ hour recorded course broken down in modules of 30 minutes or less, like chapters, so you can go back to certain chapters of it. You get the course training manual, which is the PowerPoint. My courses are very detailed, so it's 456 pages there, so you can print that out. Whatever, these are on the cloud. You'll have access. You'll have a login to access those. So this is the on-demand course, so you can get started with this right away. And then you'll get my Fibonacci price target mapping course, a 3-hour course on using Fibonacci moving averages to target your trades. You'll get my options beginners course. You'll get one trial free month of my trading club. So you access my trading club, virtual trading room every day, Q&As, libraries, 60% discounts on all courses, follow-up Q&A, access to the trading room, option trading tutorial, 15 option guide. Here's another bonus, all these different vertical spreads and back ratio, what those are. And last but not least, the Greek power tool guide. So it's a lot of great stuff there, and I'm about out of time. I wish I had more time to go through it, but I hope you'll enjoy the seminar or presentation today, and I hope you'll join me for this live course and all the stuff that I do in the future. So again, thanks for being here.
Good afternoon, everybody. I don't really have a specific agenda to talk about usually. I usually talk about what I have done for the day. So basically, let's talk about something very important. How many of us here trade futures? Basically, what I do, I mix between futures scalping, and I mixed between scalping and swing trading. But in the past many years, I resorted to swing trading and longer term trades, simply because, folks, when I do scalping, I cannot type the trade here. For example, we have a Telegram channel for indices. I cannot really type a trade. By the time I type it, the scalp is gone. So recently, and this is the subject for today, recently, since actually July, end of June, I introduced not very small scalps like 5, 6, 10 ticks. I introduced something that is in between long-term trades or swing trades and scalping. So we call them medium-term scalps, okay, which are based on a very powerful methodology that I use, and I've been using it for many years, called ACE strategy: anticipate, confirm, execute. So pointing to the word confirmation. Confirmation is key in anything you do. If you cannot confirm the trade, you cannot go in. So today's subject is scalping futures. Scalp futures using volume profile. What is volume profile? But before you join, by the way, just talking about the website and what we offer quickly. I'm not going to get into it because I don't have enough time to teach you everything. So I'll be very specific. Once we finish the webinar, and if you have questions, we have information on the website. Education here. I have beautiful videos that you need to watch before joining the trial. Trials are for 2 weeks. They're open. You need to email us. Once you click here, you will have the process. So I don't sell anything. I don't sell you anything. Once you join the trial, then we talk. If you're interested, we talk. So video number 2, please, okay, and video number 3 are very crucial before you join the trial. We offer 2 weeks trial. So again, I'm not going to be selling anything. The website is in front of you. You can do anything. You can look at many things on this page, on the education page. You can look at our indicators. I have a 50-minute video here, explains every indicator that I use, including volume profile, which is the subject today. There's adult ADD and how it manifests itself in traders. This is done by a professional psychiatrist or psychologist by the name of Dr. Kenneth Reed in 2014 for me and my members. And I usually say, unless you're getting married today, you really need to watch this one. You really need to watch it. It's very important. And then we have more videos, okay? So now on the website, besides you can go look at the testimonials. I went through a lot of issues in the past, a lot of online reviews and crap like that, simply because I am really good at what I do. I'll be very honest with you. And once you join me in the trial, you will know. I had a case with the CFTC, which I finished. It took 4 years. So I've been under a lot of attacks, but again, I'm a survivor. I'm good at what I do, and my members are very create that power. I have 165 members here on the indices channel. Elite members, you see, I have 155 elite members. So we chat. I have currencies channel, gold and silver channel, oil, which is crude and nat gas channel. Okay, so all of them are available to you if you want to try us out. There's another channel that you can join, which is completely free. You can join it. It is the free channel that you can join without having a trial. Okay, and that's also on the website. You can scroll, maybe go to the home. And if you look at it, if you scroll down, free updates right here. And we have our YouTube channel, okay? So let's go back. And these 2 videos, as I mentioned, video number 2 and number 3 on the website are very, very important. When I started trading back in early 2000s, this was my main thing. I was trying to concentrate on anticipate, confirm, execute using the tape, the bid and ask ladder. Since then, things evolved. Now they are very simple. I'm using the same thing, but you don't see it. It's embedded inside certain indicators that will give you levels without being bothered with reading any of these numbers. Okay, I created a lot of things that are simplified to a very minimum thing. Okay, if you are using support and resistance, if you are using any kind of indicators, technical indicators, channels, RCIs, Fibonacci's, MACDs, you need to combine them with something with volume profile, action. 1 second, let me mute this. Okay, I have to mute the channel here. Okay, so action, price action, you have to combine it with that. It's very, very important because technical indicators are 50-50 at best. You need to have some kind of volume to introduce to your trading. Anticipate, confirm, execute. What does it mean and how it works? In terms of volume profile, if you look at, for example, the gold, the charts are not moving now. I stopped the charts, the data feed, because I want this webinar to go smoothly, no interruption. But if you look at volume profile, for example, on the gold, and this was a trade call this morning that I did. I called the gold long. Okay, the gold has gone nicely so far, but my idea was to get a long from this price, from this line all the way up to this line, simply because in the volume profile, this area here is fragile. I call it a continuation zone. So the market, most likely the gold will continue to that level. And if you see this arrow, I have an intention to short it from there. Now, this is anticipation. Anticipate, folks. This is anticipate. First level. Let me give you an example of how this whole thing works in diagramming it in front of you. Let's assume I'm looking for a short on the NASDAQ, NQ, short. First of all, my trade calls are based on 3 contracts. T1 is on 2 contracts. So I'll take my T1 on the first target on 2 contracts. So if I make 30 ticks on T1 on 2, it means I made 60 ticks, and then I'll leave a runner. But before I call the trade, I will specify my stop loss. This is extremely powerful, and I don't think anybody else, I haven't seen anybody else will specify the stop loss before an entry. And I will show you. I have examples, and I will show you from our live trades, and I'll go through them. So let's say we make 60 ticks and the stop loss is 40 ticks. Now we can move the stop loss according to the next levels, and I will leave a runner. So let's assume I'm looking for a short on the NASDAQ. So the NASDAQ came down, okay, and then is doing this, and now you're looking for a short on the NASDAQ. And this is your target here, okay? Let's focus on one technical indicator, the most famous, Fibonacci. Some of you will say I will go short here, 38%. Some of you will say I'm going to go short at, some of you will say I want to go short at 50%, and some of you will say no, I want to go short at 62%. Some of you will say 79% here. Right? And some of you will say, no, maybe I will look at a breakout long, regardless. Now, The market comes up here, you short the market, it goes up, takes you out, takes your stop loss out because you have a random stop. Not you, don't take anything personal, please. I'm trying to explain the things to you so when you come join my trial, you understand what I'm talking about. So it comes back down, you're stopped out, it goes back up again. This time you say, this is my favorite, 50%, I'll take it. You take it, it goes up, takes you out, it comes down here. You say, no, it's gonna come back down for sure because it just maybe took me out. They call it stop loss hunting. And no such a thing as stop loss hunting. If you don't understand volume, you will assume it's stop loss hunting. There's no such thing. There's hesitation, there's choppy movement, etc. So it comes back down, you chase it, you take it short all the way, it goes up here, and now you don't want to take it because you got gun shy. You don't want to take it. So it goes up a little bit here, and here started coming down, and you reach your target. Now instead of, now you know the target. Instead of making money on this, you lost a lot of money because you took it twice and stopped out. Let me do the same example, right, with what I see. When I trade, I will tell you I'm looking for a short ahead of time. And my short area is going to be from, I will say my short is coming up, it's from this level. This is my short level, I will tell everybody. This is my short level. This is the level area. It's going to be within maybe 10 ticks, 15 ticks, or maybe just 1 tick. I don't know, depends on the volume profile on the right-hand side. Now the volume, when the market moved ahead of time, I had clusters of volume, such as this thing here. You see clusters of volume. Let's go to the NASDAQ. Clusters of volume, and these clusters are, you see these clusters of volume? Let's go to a smaller chart. These clusters of volume, I see you can minimize it. You see, you can sharpen the edges. You see that? These clusters, they all mean something. The yellow, the green, the bellies, the bellies, the valleys, the red zone here, they all mean something. But they all, to simplify it, they mean simply two things. Continuation zones, they mean two things. Continuation zones, okay, versus continuation zones versus the rejection zone. So continuation zones are here. This is a continuation zone. You see this? This is a continuation zone, continuation zone, continuation zone. In between, you have little rejection zones. These are your rejection zones. I'll purple them. This is the rejection zone in between these two lines. So far, so good? So if I know this is the fact, what do I do next? The market is retracing up. The NASDAQ is retracing up. Is this a good area to take it? Short? Now, all of a sudden, because you took it before, but now you are trained on volume profile, you would say, no, that's not good because this is a continuation zone. Continuation, C. So it might continue all the way up. All the way up. So if it touches here, are you going to take it short? Of course not, because it's in the middle of a continuation. It's crazy to take it short. Now you have, this is the level that I assumed, which I by assumption, I mean I anticipated to go short. Now we're looking for confirmation. This is where the game starts, right? This is where the main game starts. Give me a second. My students are chatting, talking, okay? Hold on. So okay, this is the main thing. Let's go back to the presentation, which is this here. Market touches this area. I'm assuming, or I'm anticipating it to come back down from here. What do I wait for? I wait for something called confirmation. Confirmation is what I'm waiting for. The confirmation is either going to come up while the market comes here, or it's already there. Confirmation is nothing but volume embedded inside the market that you don't see unless you actually extract it, and shows here. It flashes maybe, or it comes up as a line. We call it SAL indicator. It will take out or make visible to you what the market movers are intending to do. Where are their heavy levels? Similar, imagine you're doing market depth, but in detail, you understand exactly how it works. So here I'm waiting for confirmation. Once I confirm my entry, I will go in short. Now, I told you earlier, my stop loss, if I call a short, it's determined ahead of time. So here's the question for you. If we poke into this, if this area does not confirm and it pokes into this area here, where do you think my stop loss should be? Should it be at red, blue, or purple? Automatically, this is your stop loss, the red. Why is this your stop loss? Because if the red is taken, all the rest is taken. So now all of a sudden, you are a different trader. Now you know where your stop loss is. Now you are securing your losses or reducing your losses. That's a major thing. Okay. Now I know my stop loss. So before I call the trade, I already know my stop loss. And 90% of the times, I will tell my members, if I am trading short on the Nasdaq, I'm going to take this is my stop loss, and I will going to take, let's say, 15 ticks or 20 ticks first target. Even that target, first target, it comes from the first hiccup against us, and I can see that in details in the volume profile. So far, so good. Okay. Let's look at something today that happened, and then this is today. Okay, this is not something I am. And then we execute. I told you about execution. I told you we do 3 contracts. First target on 2 contracts, and we leave a runner. And then we chase the runner with a stop loss. Even that stop loss is a smart stop. Smart, which I'll explain. Stop. It's not just a random stop, okay? So, going back to today. These are the indices. Okay? Not this one. I want and show. Okay, these are the indices channel, for example. And look at the time, look at the date. August 12th, today, this morning. I said RTY, Russell, possible long at 22.43. 22.43. No confirmation, leave it alone. So I anticipated a long on RTY, and there was no confirmation, leave it alone. And this is seen by like everybody in the indices channel. RTY possible short from 22.44 and 46 area. Looking for a push long to 22.60 area if I find a good support. And this was another time. This was 3 minutes after. So, and then main, I said Nasdaq main support 14924. 14924 main support is here. You see this lower line right here. You see it, folks, right? This is today. This is today at 9:40, 9:30, 39. And then RTY possible long. And then ES looking for a long all the way to 44.88. I was looking also for a long on gold on these are my top-down analysis first thing in the morning. I was looking for a long to 44.88. I think we're gonna make it today. I think it's already halfway through. Finally, I found a trade that is really, really very possible. I said Nasdaq possible short. You see this? At 149.88. Pay attention to this. Sorry. What did I do? I messed up the view. 1 second, folks. I'll give you the idea of what I was looking for. Just bear with me, okay, folks? I messed up the view. This is the view. Here, this was the time of the day when I said NASDAQ possible short at 14988. You see the line, 14988 area. And I said NQ possible short a few minutes after. You see 951. NQ stops. See, I have not called the trade yet. You will see how I call the trade. NQ stops at 92. So I'm looking at 92. See this line, this 92? NQ stops at 92. So I already determined my stops ahead of the call. At 9:51, NQ short now. Take T1 at 80. So it was live right in front of my students. So they heard me verbally, and I texted to them exactly. If you want to know what price, you go to 9:51 on your charts, AM, see what price it was. So basically, I told them take a short around, it was around 80, because it touched 88. You see 88? It touched it. If I reduce the charts, here at 88, it confirmed, and I called it short. You see that move, folks? You see how it moved? Now, that being said, I did not move my stop loss prematurely. I said new stop loss now at 90. It came up again. It gave us a nice profit. It went up again, and then it bounced back down. Then I said 14930 is your target. 30 is this one here. This is your target, 30. Sorry, not this one. The middle line right here. This is your target. Folks, at one point, I said exit now, or I'm going to move my stop loss very tight to the level. It did not touch 30, so I got out at around 50. So if you see this, NQ has a 150 ticks move, new stop at 85, and then I said new stop at 56. 56 was right here. This is 56. So basically, I made only this much of it. This was a 100 and I think 170 ticks combined trade. 170 ticks, one trade. Okay, we had 125 ticks runner, and then at the same time, folks, I called an RTY long. Same thing. I did the same thing. RTY, if you see here, details. And I also gave my students, you see this is RTY. I gave them a level. 22 here. So if you see the same thing, see this? That was the long. See? And my target is 22.40, whatever. Very, very, very powerful. Gold. Same idea, folks. I can show you this. It's right. It's typed gold. This was my long, initial long, first thing in the morning, even before the trade. It gave us beautiful 50 ticks. We made some profit, first target. It came back, took us at break even on the runner. And then now the gold is going. It's not even stopping. It's going to the target. My target on gold is 1770, but we are not in it because it stopped us out. On the pound, I called it long before we came in to the session. And the pound is basically now here. This is the pound. My long one was from below 30. I think it was from here. I called it. And it gave us some, see, I'm looking for a pound to go up. And if you look at the currencies channel, this is very interesting. You need to pay attention. Currencies channel, the pound, if you see the pound, I said I'm using pound US. Pound US, you can use the Forex side or you can use the future side. You can trade pound US or you can trade the pound. Okay? So far, so good, folks. So far, so good. Maybe I am going fast, but you have a 2 weeks time with me if you join the trials, okay? Hey, Simon, the Telegram channels and the trade calls are hidden gem. Thank you, Julie. Do you offer a Telegram only price? Yeah, I mean, I don't do selling. Once you join us, you will decide. We have different packages. So let's leave that. Maybe you are in a trial, you can talk to JR or maybe talk to me after you finish your trial. I think you still have a few more days, so not to worry. The focus on. Yeah, I mean, if you can't see because maybe you're logged in, Trader is saying he cannot see the cursor. Maybe you could join the trials, Trader. Believe me, I don't expect anybody to get the whole idea from this. That's why we offer 2 weeks trial. Let me show you another example. This is from a live session, okay? I will remove the questions for now. If you don't have any more questions, I'll move on. I have maybe another 18 minutes left or so. So I'll get to the questions later, but for now, folks, this is a video, okay, of hold on, 100% shrink to fit, 75% no, shrink to fit. This is a video from I think yesterday afternoon I did. This was after the trading hours. We have 3 days live sessions, 2 hours in the morning, and the rest of the week and the time, because I go until late afternoon, sometimes early afternoon, I call trades on Telegram. Pay attention to this. Hopefully you guys can see this writing, right? Hopefully you guys can see this writing. RTY, big support now, and RTY is right on the right hand side. Big support. You see 22, 21, 22, 20 area. If I move, just focus on the typing. See this? This was my RTY initial short area, and then long from there. Big support now. See RTY runner. I already had a trade earlier that morning, and I type. You see it in front of you. I typed 2220 support, 2220 RTY support. Now I got the NASDAQ taken over the RTY because it had a better support. Watch, this is the NASDAQ. The small chart is the NASDAQ. Again, it might look confusing because of a lot of lines, but this is music to my ears because I love it. It's all the hidden volume in the market. I can see it in this here, up to 50 levels. And that gives me huge confirmation, huge comfort. Okay. NQ2 at 14985 support. NQ, because earlier that day we said NQ has a support at 85, it's coming back to 85. Watch the details that I'm giving my students. Watch, just read. I have not taken a trade yet. I have not taken or called a trade yet, because if I call it, I'll say, this is my entry, this is my exit, take target 1 and leave a runner, right? So I'm just waiting. Pay attention. Waiting. RTY stops at 2218. You see, I have not even called the trade yet. I said RTY stops at 2218. 2218 is here, right at the bottom. You see it, folks, right? Because the volume told me this is a wall above 18. So 18, if it hits, it's going to go much lower. NQ stops at NQ. NASDAQ stops at 65. You see, NASDAQ gave me the stop loss already. Not like I was not stopped out. You have to understand, it gave me the level where I put my stop loss in. Very detailed. So, and I said, if I call it now, you see this, if I call it, I have not called it yet. I have not called anything yet. I'm looking for the volume to stabilize, and I want to see market movers. What are they intending to do? Remember, I am currently, for example, where the markets are, both of them. I'll give you that example. Since I'm looking for a long, I am currently here. I'm looking for a long. You understand? I'm currently here. This is a reversal area. I'm looking for a long, but these are attached areas. I'm looking for a long, but I cannot take it randomly. I have to have market makers giving me the signal saying, okay, let's go buy, because this is the reversal area and where my stop loss is. So I'm looking for a long from this area on the NASDAQ and the RTY. So I have to be detailed. I have to wait for the stop losses. I have to wait for the market makers to give me that assurances. After all, I pick, my trades are about 75 to 85% probable. I wait for those. I'm very patient, even for scalping, folks, even for scalping. Okay? And wait, look at what I type. Just wait. RTY looking to see 2219 holds before calling it. And RTY is right here. 2219 is holding. See how it's giving you that feeling that it's going to break, but it's not, because I see pressure mounting at the bottom. You see that pressure mounting at the bottom around 18, which was initially, if I had called it, would have been my stop. And look at the NASDAQ, it's breaking my level. But look what I say to them, my members. I said NQ 68 has to hold. 68, where it is, 69, 68 has to hold. Okay, finally. Watch. Very detailed, folks. And of course, if you don't know, you will say this is a fast call. But as a student, if you join and learn the whole thing, the membership that we offer, which is including education and indicators, you would see it yourself. You don't have to wait for me to call it, because I'll educate you on that. We have a massive amount of very important education. Okay, so RTY new stops is 2216. If I find a good entry, see this, I'm calling the stop loss ahead of the entry. Okay, watch this. NQ stops at 62 if I find a long. So I'm already establishing those stops. Long NQ now at 70 or better. I'm looking at NASDAQ long from 70 or better. So 14970 or better. Meaning if it goes below, even better. Your stop loss is smaller now. See? Watch. Now, that being said, I neglected to call the RTY, because by the time I focused on the NASDAQ, the RTY was jumping at the same time. So I didn't want to get in a bad entry. Anybody caught it themselves? They caught it. Students, they know how to do this. Okay? See, and look, do you remember we talked about confirmation? See how the confirmation, I don't know if you see it, folks, but do you see how 70, just below 70, that confirmed? Do you see that magenta line? Okay. These trades recently that I've been offering to my students, and I'll continue offering them, they are on top of the swing trades that we do. Okay. T1 was, see, I said T1 hit, because I told them T1 take it at 79. So folks, from 70 to 79, what is that? That's 9 points. 9 times 4, what is it? 44 ticks first target. I grabbed only 30 ticks first target, because by the time I called it, my entry was a bit late. I could not find my execution chart. It took me a couple of seconds, but I made 30 ticks, 30 on 2. That is 60 ticks, folks. But most members made 44 ticks, 88 ticks on target 1. 88 ticks, and that's a scalp. Okay? So if you see, and then got 30 on 2, and then students got 44, and now move stop loss to 64, and it flies. Anyone got RTY, and they tell me they got RTY. Some of them got RTY too, and that's how it goes. Okay. When I mention in the website, not me, I mean my website manager, when my website manager mentions that here, where is my website? When my web manager says 1,000 ticks per month achievable, we are not kidding. Really, it's easy to achieve 1,000 ticks. I grab hundreds of ticks off of a trade that starts with a scalp, because I chase it with a runner. I know the smart stop. I know how it works. And I pick only the good trades. Sometimes we will spend 2 hours without calling a single trade, because I don't see that 80%, 85% accuracy, okay? And you will see more videos in the educational session. YouTube channel, please make sure you look at our YouTube channel. It's very, very important, okay? I have some education too, all right? It is very important to look at the funding. We have companies that you could maybe do fundings with, okay? And couple of things I don't do. I don't chase. I don't call a trade just because I was stopped out. If I get stopped out, I accept it. I move on because I know I'm very comfortable with what I do. And this is students now chatting, see, and talking. For example, I mentioned about who grabbed the RTY. RTY was a long here, and RTY now is massively up. I think, let me look at the site. I called it long, and now it's already up nicely. Okay, Nasdaq. Remember Nasdaq? I was looking for a long. Earlier I said this is my support, but 24. Remember 24 earlier today? And while I was talking to you, I said I showed you 24, which is this line. It missed my level. So if it misses my level on Nasdaq, what do? I try and catch it from a different level. If it gives me that anticipate, confirm, execute view. If I don't get, I'm sorry, not this one. Not this one. Not this one. I'll show you. Okay, just give me a second. If I don't get anticipate, confirm, execute, I don't get in a trade. So, and I got into this webinar, so I missed my calling it again because some students did not catch it early enough. Okay. Let's look at what else is next. I talked about how do we trade, 3 contracts, stop loss is established, how many contracts is 3 or multiples of 3. When I started this, folks, I started back in the early 2000s. See this picture is from 2006. I was doing seminars, live seminars in the Toronto, Ontario areas. I think this is in Brampton, Ontario. This is Mississauga, Ontario. Come on. This is Colorado. If you look at this, sorry, the screen cut off. This is Colorado in 2012. This is Las Vegas in 2013. Okay. Do you trade what you feel or you trade what you see? Folks, there's something I always say, trade what you see. Do not trade what you feel. Never. It's always what you see. News, politics, elections, they're all designed to distract you, to somehow I feel like they are designed to get you to do the wrong trades. Okay? I think I will give chance now to questions while I'm doing this. Anybody has questions? Please let me know. Is volume indicator yes, we made it, it's ours, it's specific to us. It's not something you can find. Yes, thank you. Julie, I've actually been in a trial for a week. I was skeptical, of course. I mean, it's not easy, especially if you don't understand what we do. So that's why when I tell everybody, please, please, please look at these 2 videos on the education side and the education page. Look into these first video number 2 and video number 3. It will get you to understand more. But I took all 4 trades from August 11. Okay, yes, we had nice. Yeah, it was win, 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 and then a stop out on crude for 2. Yeah, just under 300 ticks. That's my alarm to end my session in 5 minutes. So yeah, we got under 300 ticks yesterday. Yes, you're right. I did 311 because yes, yeah, you did better. Yeah, excellent. Thank you, thank you. And ACE, anticipate, confirm, execute. Yes, anticipate, confirm, execute. That's the way we do it. Now, again, trials are key. We don't accept anybody unless you come in as a trial member first. I personally will welcome you after you get qualified. You don't have to pay anything, nothing. And at the end of the 2 weeks, you might say, Simon, maybe I was busy a couple of days. Can I get 2 extra days? Sure. I like it. I'm really interested. Can we do payment plans? Sure. Let's talk about that. I mean, it's all about negotiation. Okay. Now, indicators are currently only available on Sierra charts, and here's why. There's the main indicator that gives me the confirmation, which is these magenta lines. As you see, the charts are frozen now because I disconnected the data feed. These magenta lines, which is SAL indicator here, it's based on a few things that also includes market depth, historical market depth. No other platform I have seen that they have historical market depth. They do have market depth that is not historic, just live. So which means it will only give you a levels while the market is moving around the price. And once you shut off your computer or charts, it will go away. It starts from zero again. So I am trying to build it for NinjaTrader. It will be similar to this, not exactly, but the rest will be the same. Like volume profile will be the same. Okay, if you look at the volume profile, should be the same. We already had those on NinjaTrader 7. I'm trying to do them on NinjaTrader 8. Again, it's a long-term project. Okay, gold, you see the volume profile and the whole thing. You can look at, of course, short-term as well. This is short-term gold, 30-minute chart. See, it's different. See how it accumulates. We have DRLs, dynamic reversal levels. If you see, for example, this is a dynamic reversal level that will prompt maybe the market to come back down against it a little bit, maybe here. This is support dynamic reversal levels. So that we have some powerful indicators based on the volume, different aspects of the volume. You will get it all, but it's all based on Sierra charts for now. Even my pound, if you look at the pound, this is the pound on the futures market, BP, and this is the pound on the Forex market, the pound US, okay, which I called long, and I think it gave first target, and now it's backing down to the entry level, okay? But it's a very slow movement. It's not like the NASDAQ or the gold or the crude or the Russell where they move hundreds of ticks, okay? Why is that traders that you use? What is the trader that you use? What trader? What do you mean? Platform? I use Sierra charts. Yeah, I use Sierra charts. Now, that being said, if you don't want to switch to Sierra charts, you can easily continue with whatever charting system you have if you're comfortable with it. You can pick a level. If you join us, you can pick just following my trade calls, market analysis, and join the live trade room that we have 3 days a week. You don't have to get the indicators. That's a different package. You don't have to pay full price if you cannot. But then in the future, you will realize, I need to switch because I need to learn this whole thing. Although with me, you will learn regardless. Even if you join me as a trial member, you will learn. You will learn a lot because I teach a lot, even for new trials. That being said, I'm done, folks. Thank you very much. Anything you want? Where is the thing? Anna, can you share the handout, please, to everybody? There's a handout that I want to share to everybody. If you guys want to do it. Sorry?
Sure, Simon, then.
Okay.
Okay.
So thank you so much, everybody. If anything you need, just go to thetraderinstitute.com or get the handout that Anna will share with everybody. Appreciate it. Thanks, Anna. Appreciate everybody. Bye for now.
All right, well, thank you everybody for being here. Thank you, Anna, for having me back again. I want to, don't want to get too serious. You know, I'm a fun-loving guy, but the idea of focusing on your mental and emotional capabilities has been my passion for the last really 20 years, because I have proven to myself, as I'm about to prove to you, that the notion of giving equal attention to what's between your ears, when it's the same attention that you give to learning a trading plan and trading system, only then can you be the trader that you hope to be. Now, I know from a statistical standpoint that 9 out of 10 of those listening to this presentation today are either struggling around the zero line and kind of getting nowhere fast. It's kind of like being in purgatory with your trading, or you have been losing and you've lost a series of times over and over again. I don't want to sound depressing, because there is an answer. There is rising from the ashes, and I'm going to show you how to be that phoenix that rises from the ashes. But I wanted to focus today on something that is unique from the standpoint that it's really become a major situation only over the last year, 18 months, the fear of missing out. There are a lot of mental and emotional challenges that different traders can have depending on who they are and their experiences in trading and their background. But fear of missing out has become very common, and I'm going to go through exactly why that is. But first, let me give you a little bit about my background. I put 39 years of trading experience, because when it went over 40, it made me sound old. So I'm sticking with 39 years of trading experience. And you know, there are a lot of traders out there that have 1 year experience 39 times. That would not be me. I'm a person that continues to adjust, continues to analyze, continues to better my performance. In fact, I've written several books on how to design and construct an effective trading plan. I think these are still, all of these are still on Amazon. I've written books before this in my career, but I'm probably best known for my 4-minute drill for traders, which you'll see kind of a picture of down here. And I've done over 200 of them, and they're really motivational type of 4 minutes that hit you with the truth, like I'm going to do today, right between the eyes. I worked with Payne Weber. I put in some time with them, a couple of years. Didn't last long. I was a commodity specialist for them, but it was actually too much of a sales firm, believe it or not. So I didn't really fit there. Before then, I was a regional vice president for the International Trading Group, one of the first option firms in the country before there were exchange traded options. And that was a very interesting experience where I supervised 60 traders in my own office, and I developed other regional vice presidents for other offices. But I noticed from viewing these traders that those that had the simplest of trading plans were the most successful. And I just want to kind of give you that tip. I have something called simple trading plans that we do also, but that's for another discussion. My main focus is the mental and emotional capabilities that we all have, but don't necessarily utilize what we could be to become the winning trader. I formed the Hallett group after I left Payne Weber, where I was managing with my own commodity trading advisory fund. Money for rich people. It was a minimum $250,000 account. At the time, that was pretty big back in the 80s and early 90s, and I managed it through my own introducing brokers, so that I had 2 streams of income every time I placed a trade. It went through my own IB. So that was pretty good time there, and a lot of great experience as far as the pressures running other people's money. That was a successful venture. It's just that it got old. I'm kind of a type A, and I'm always looking for new opportunities. But as I met with others that were interviewing me and so on for success that I had in all of these places I just mentioned, it occurred to me that really it's the mental and emotional part that traders really need to get in touch with. And that's why 20 years ago I went ahead and started the Disciplined Trader. Actually, I've been married 40 years. And about 2 years into my marriage, my wife would see that I was coming out of my office and saying, I looked down every time I had a losing day, and I was dancing around every time I had a winning day. I was letting my emotions control my winning and losing, and I wasn't getting really where I wanted to go. I was one of those people hovering around that zero line, that why am I wasting my time line, that nothing's happening. And she, who is my wife, is one of the world's most accomplished subconscious trainers, and she makes all the content for our site. She helped me to train my mind in the same way that we train other traders' minds now to be a successful, disciplined trader. And that's really where it all turned around to me. And I said, you know, it's not the trading plan, it's the ability to follow it without any reservations. And I mean, you can think it's the trading plan, and you can hop from trading plan to trading plan, but I think you've probably already experienced that's not the answer either. So let's move forward. And I wanted to just prove to you first, very quickly, that 90% of traders lose money. And the question is that a true statement or not? I mean, we all hear it, but is it true? And when I say traders, I mean anybody. I'm talking here mostly of day traders, those that are involved with closed contracts, equity, where you buy and sell a stock, or futures, where you do the same, forex, options, anywhere where there's an initial opening of a position and then a closing of a position, mostly in the same day. If you're a scalper, you're doing it within minutes, sometimes seconds. If you're a day trader, you're out by the end of the day. If you're a swing trader, sometimes you hold it for a couple of days, sometimes a week. So whatever category, most of the category that I'm speaking right now are the first two, mostly, although there is no difference really in my studies whether you're a swing trader and hold it a few more days. Generally, if you're a short-term trader, 90% of you are losing. And here's the proof for you. There are 4 basic studies that I found after really spending almost 2 whole days looking for studies. A lot of them I did not count. They had the same results as you're about to see, but I don't bring them forward. I just brought the 4 that I thought were the most important for you to see. You can look it up yourself. Some of them counted accounts that opened and closed within a week. I don't think that's somebody who was thinking about doing it and not doing it. I wouldn't call that a break-even account. Some of the figures were skewed. Most of these studies, in fact, especially the last one, had a certain condition for how long an account was open, 300 days or more in the Brazilian study. This first study is the North American Security Administration Association. It was formed in 1919 and 102 years ago. Now, it's a group made up of the securities regulators of the United States, Canada, and Mexico. And they're here to protect us. So they did a study on who wins and who loses. There's a European study, European Securities and Market Authority. These people safeguard the stability of the EU financial system by enhancing the protection of investors and promoting stable and orderly financial markets. So it's pretty much the SEC kind of the only on an independent basis, the European Security Markets Authority. The third is really not a study, but a country that took a look at what was going on in its own country. National Securities Market Commission decided to pass a law based on what they saw to make mandatory disclaimers if you're advertising going into the kinds of trading that we do. I'm going to show you that. And then I'm going to show you a Brazilian study that I believe probably is the most believable and you'll have to read it yourself from how they went ahead doing the study. But the Brazilian Stock Exchange is not it's kind of crazy, and it's pretty well known, although it's the third biggest in volume in the world stock trading entity. And these three people, Fernando, Rodrigo, and Bruno, are three of the most well-known traders in the exchange or related to the exchange. And they did a study. I'm going to show you that too. I think it's going to freak you out a little bit. So this is I'm just going to show you a page on each one. We'll take 30 seconds on each one. This is the North American study. And if you see right here at the bottom, it said only 11.5% of the sample evidenced the ability to conduct profitable short-term trading. Okay, so there's 88.5% losers. Okay, that was done in 1999, and when my wife looked at it, she says, "Boy, that was long ago." Well, it wasn't really so long ago, but the other two are more recent. Three were more recent studies. This is 2018, and this I almost didn't put it up. It was a major study, but these were voluntary. They asked these entities to submit their paperwork, so to speak, and you can see the best of them had 2/3 losers and 1/3 profitability. But you're only seeing the first page. Here's the second page. The worst of them had an 86% losing. And so this was a fairly extensive study with an average of 76.3% losers. And, you know, I'm a little bit, you know, when you do things voluntarily instead of open your books and let me see, I think it may be a little bit skewed toward the positive. I'm going to leave it there just for your edification. You could look at this study yourself if you want. Here's the from Spain. Here is the National Securities Market Commission resolution. This is 2019. And what it did was it took a look at the CFDs, which is the contracts for, let's see if I put a contracts for closing contracts. I figured exactly what the letters are for differentiation, or let me see. I think it actually tells me there. Now you got me wondering. For deference, financial contracts for deference. That's CFD. It's anything that closes. Okay, and they, based on that study, they now command all advertising in the country of Spain to have this is your durable medium web page standard risk warning. High risk of losing money rapidly due to leverage, and between 74 and 89% of retail accounts lose money when trading these things. And you should consider whether now if you want to abbreviate it, you still have to bold and give this. Now, if you're doing this, you know, I'm looking more at the 89. You know, maybe again, I'm just trying to prove my point here. But I think, and this kind of helps me with my averages. This is the Brazilian study that actually took place just more recently, but just last year. But it studied accounts between 2013 and 15, when they found 97% of all investors who persisted for more than 300 days lost money. Okay, 97%. Only 1.1% earned more than the Brazilian minimum wage, which is about $15 a day, and only about 1/2% earned more than the initial salary of a bank teller, which is about $50,000 a year, all with great risk. So even though they may have earned money, it was while they were highly stressed. Many may not have lived through it. And if you look closer at this 1.1%, I'm not showing you the chart here because I have to make a briefer presentation than usual. You'd see that a vast majority of these people made literally dollars and tens of dollars, not hundreds of dollars a day. So if you add all of that up, I think you can see that 90% of traders around the world are losing. And most people lose money. Okay, we know that. We know that now. If we didn't, so my question to you is, why is trading so popular? And I'd like to just pause just a second. And no, I think you've all heard 90% lose, but let me ask you, why do you think trading is so popular, even though most of you are losing? Why do you keep pounding at it? Why do you keep doing this? If you can throw it in the questions area, I'll read it out, and you know, it's the dream. Anything that you want to comment here, because I'm going to give you some of the answers that I think you may be looking for. Sky's the limit. Self-directed, self-employed. Sky's the limit. Yeah, you know, greed. Yes, I mean, all of these things are true. So let me give you what I found. And again, we have I talk to a lot of traders through our coaching, kind of get to know them, and again, with the formative drills for traders, I've over the years, I've happenstance with a lot of traders. Reason number one, there's very little regulation when it comes to advertising. And I knew this, whether it was Payne Weber or International Trading Group, didn't matter. As long as you use the words like can, this can be for you. This can be you, okay? Or phrases like it's possible to, like it's possible to triple your money in just 2 weeks. Plus, if you use the boilerplate disclaimer somewhere in your ad, like trading futures is risky and only risk capital should be used, past performance is not indicative of future results. I mean, I know it by heart. Everybody in the business knows it. In fact, you probably know it, having read so many of them. But generally, if you say these things, you're good. So, you know, the sky's the limit was a comment that I just read from one of you, and it's so true. It just keeps the dream in front of you. Okay, the second reason, and something that you may not think of, and something that I learned when I built trading plans, is that the trading plan or the trading system that you're using, the difference between trading system and plan. The system is where you buy and sell, and how you pick a position and so on, and how you manage the position. A plan is the overall plan. Your mental training, the risk that you're willing to take before you take a trade, all of the things that surround the trading system. Okay, but the trading system and plan that you're using and the trader themselves, you are not a match. And if that's not a match, you have a problem. This is one of the reasons why traders keep losing. Firms that sell trading systems and trading plans are good at one thing, educating you on running their system. Let's call them gurus. Now, they don't know you or your personal strengths or your personal weaknesses, and if their plan is actually right for you. For them, it's one size fits all, okay? And the truth is, I was going to say nobody knows the truth better than I do, and I think that may actually be a true statement, because most gurus, and I'm going to throw myself in the guru category right now for lack of a better term, most gurus are talking to traders about where they buy and sell and why they're buying and selling, where they're buying and selling and managing stops. I talk to traders about why they hang on to beliefs and why they chase markets, why they're a victim of FOMO and so on, why they have no patience when they trade, why do they think that? That's what I'm into. And so I know that every trader is a little bit different, and the trading plan needs to match that particular trader. For instance, a slightly ADD trader, I'm going to put myself in that category, who lacks patience. Generally, I'm not a patient person. I have over the years developed patience when it comes to trading, but it's not my forte. Okay, I've learned to do it, but I have a trading plan that doesn't require a whole lot of patience from me. And when it does have patience, I'm okay with it, because I've learned to train my mind to be patient. But it's better that you go with what's naturally good for you, okay? As a slightly ADD trader who lacks patience, should likely not be in a trading plan that's waiting for certain criteria to fall into place. So one, moving averages crossing, the volume to be right, waiting for all the hoops to jump. I'm better off with a plan that has frequent signals, where I'm jumping in there and managing my risk. Okay, that's a better kind of trading plan for me. A trader who is a person, and this person is like my accountant, usually cautious when being would be best served by a trading system that does have you jumping hoops, that had several confirming hoops to jump before you initiate a trade. Every time I go to see my accountant, he's in there trading options, you know, and he tells me, he has me wait in my waiting room, in his waiting room, for 10 minutes while he patiently waits for the premium to fall in line. So he's a pretty good trader. Of course, he's trained with us in the past, but he has learned to have a trading plan that matches who he is. And even more deeply, a trader whose father was a gambler. And one of my best friends, this was a situation with him, saw his family finances obliterated, may be best served by a trading plan that keeps trading losses to a maximum of 1% per trade. Because if you have a trading plan, even with 2 or 3% trade, and you lose twice in a row, a person who has a family history of gambling and losing money and so on, ruining a family, they're going to hesitate to pull the next trigger. So not only do you need to train your mind to ensure that the capabilities that you have to be patient or to act without hesitation when your trading plan gives you a signal, you have that, but life is a lot easier and a lot quicker to that road to success if you match who you are with the trading plan. Okay, I hope that makes sense to you, because this is a huge, huge key. The truth is there's no one-size-fits-all trading system. And reason 3 is the industry doesn't care. There's something called the hopping game, okay? I call it the hopping game. We've already established that the vast majority of traders lose. This is true no matter how good the trading system is, okay? So you've got all these people. I don't think there's a person on that I've ever seen Anna come forward with that doesn't have a trading plan or system that would not work if you would follow it, okay? So they're out there working, but we already know that it's not about the trading plan that makes you a winner or loser. It's you, the individual, doing the things to control yourself to run the plan. 90% of traders are losing because there are 2 necessary components to winning trading: a valid trading plan, which reputable gurus do supply, and the ability of the trader mentally and emotionally to follow that plan, which they do not supply. So gurus are good at teaching you how to run their trading plans, their trading systems, period. Although responsible firms will give a mention of the importance of mental and emotional management to successful trading. They'll write articles, they'll have a video, they'll recommend books. Not going to work for you, because you have to work with your subconscious mind in order to get that done. That's not enough to turn destructive behavior to supportive trading behavior. It's just not their field of expertise. So the losing continues. But here's the worst part. Rather than encouraging traders to do the inner work, which to the guru's defense, most traders don't even want to hear about doing the work. Okay, most traders don't want to hear that, and it's not the guru's expertise. Most traders they've learned to let their ego be some of their defense. And I'm not pushing you on this. I'm just identifying what I've seen happen with people that we work with. Here's what's happening. When a trader loses, and 90% will, we've established that, they will look for another holy grail because of the bombardment of advertising that keeps the dream alive, okay? Gurus know this and understand this and can lead to cross-promoting. From a marketing standpoint, we all build lists of potential buyers. I have a list, Jousef has a list, everybody has a list. For those who don't buy our system, many gurus will actually promote other gurus' systems and grab a commission for the referral. Okay, and there's nothing wrong with that, except a trader who finds his or her way to profitability is making money and content, and they stop buying. In other words, when that 1 in 10 finds their way, they stop buying. Okay, so in the end, it serves the industry that you don't win. It's not like they're learning. They don't want you to lose. They do want you to win, but they're not really doing the things that would allow that to actually happen, because that's not their expertise, and you don't want it anyway. I'm here to tell you, you need it. You need it. And so, they sell, when you sell something, you sell something people want, not what they need. I got to tell you, you need this, and I hope you want it now a little bit. Okay, so in the end, It serves the industry that you don't win and that you keep hopping from trading system to trading system, and you keep buying, like those disposable razor blades. Let me be clear. I'm not saying that gurus don't want you to win. I know 100 of them, hundreds of them personally, and I can safely say they do want you to win. But the industry is not set up like that because it de-emphasizes the requirement of mental and emotional management to succeed. It's the trader who doesn't want to face the truth. So why should the guru emphasize it? Okay, that's the real bottom line. That's the real bottom line. Okay, only 10% of short-term traders are profitable, and it's not because only 10% of traders have great trading plans. Most of them have terrific trading plans, and they've had several of them as they move from trading plan to trading plan, because that was never the case. That was never the issue. It's because it's a mismatch, or they haven't worked on what's between the ears. Okay, only 10% of traders do anything at all to improve their mental and focus and emotional control. I can tell you that because that's my business. When people come to me, only 1 in 10 tell me they do anything at all or do very little. You know, they write down their trades at the end of the day. That's not what I'm talking about, although I count that as little. At least it's a review of what you've done. Only 10% do anything at all, and 10% are losing. Okay, only 10% are winning, and 10% do anything at all about to improve their mental focus. The fact is that these two statistics are directly related. Okay, now the bottom line is the ball's now in your court. You may not have realized all of this, now you know. Okay, so now it's kind of on you. Okay, if you're ever going to finally be a consistently profitable short-term trader, you'll need to include a process of managing your mental and emotional capabilities, and I'm practically going to give one to you for a price that is practically giving it to you. I don't know what you paid for your last 2 or 3 or 4 trading plans, or 2 or 3 or 4 refinancing of accounts to get back into trading, but based on that, I'm about to give you something. So I pose a question: what is your primary thought or emotion that has you trade in a way that compromises or hampers your trading success? Just think about it for a second. What's the real mental emotional issue that's getting in your way, that has you stepping on your own success, that you keep on doing over? We call it unforced errors, or in tennis. Okay, well, I took a poll recently. Actually, this was taken about a year ago, and you can see where it was a multiple choice, and you can see the percentages here. It's amazing that lack of confidence, patience, fear of losing, hesitation to pull the trigger, even trouble overcoming losses, and greed, they're almost equal. I mean, the first 4 are just about equal, but the commonality of the issues can vary with the market conditions. What I'm saying there is that as markets get more and less volatile, say, or seasonal, I can't explain exactly what I mean in this lecture, but what I'm saying is that this right here, over the last few years, something that wasn't even on that chart, the fear of missing out, has really risen to the top of the mental and emotional situations that need to be reversed. Where patience replaces the fear of missing out. Most of the problems that we have as traders from a mental and emotional standpoint are fear-based. But over the last few years, this fear of missing out has become, and why? Because the current environment of volatility and huge daily, weekly, and monthly moves, the current environment has invited us to have to move more quickly, otherwise we miss out on buy-in tech moving from 100 to 450, means back down about 370 today, but in a matter of a month or 6 weeks, these are and that's not the only situation. We've had unusual movement in all markets. Soybeans hitting $17 or $18, just crazy stuff going on. Corn being more expensive than wheat. Just a lot of different things happening that are causing volatility. and huge daily moves. This is contributing to a trader's fear of missing out on the next big dream move. Okay, our brains are like an onion peeling back. When we work with clients in our coaching, we find that the fear of missing out and the fear of losing are intertwined. Okay, and when you peel, it's like peeling back an onion. Okay, the fear of losing is one layer. The fear of missing out, hesitation to pull the trigger, lack of confidence, trouble overcoming losses, lack of patience, greed. These are all layers of the onion that when you solve one issue, another one pops up. And when the other one pops up, you have to get to the truth by eliminating what we normally as human beings put in our brains to protect what we believe in now. I mean, if you believe in something strongly, it takes a lot more than just somebody else's opinion. It takes proof. It takes proof and then more proof. It takes proof and then time that there's no other. It takes a lot of convincing to peel away the layers. And it's true of what you've done to yourself at this point. And it's understandable. I did it to myself before my wife helped me out. Okay. And I'm going to help you out today at the end of this. Okay. And what I'm saying is that you need to peel back the layer after layer, and it doesn't take long. Our process for doing it requires you to spend 7 minutes a day for 2 weeks, 7 minutes a day for 2 weeks for each layer to be peeled back. Okay, so I don't want to get into this because our course shows you exactly what I'm talking about in detail, and it's not a lot of detail, only a little bit more detail on what I'm trying to say to you. So you have to approach each situation on an individual basis, which exposes the next situation. You know, in selling, when I was with Payne Weber, they always asked us to ask questions. They taught us something called reversing, which means when a client said to me, well, I'm not really ready to invest in that stock, I would say to them, when you say you're not ready, what do you mean? I would take their question, what their answer, and I'd push it back to them as a question. And then they would say to me, well, you know, I'm kind of a little tight for time. And I would say, tight for time? So I'm continuing to push back, trying to peel back that onion until I hear the answer. Well, my wife doesn't think I would be able to do it. My husband wouldn't be. So if we could get your husband to do it, then it may be good for you. And I would get to the answer. But there are defense mechanisms in your brain that, I mean, the fear of missing out is protection against the fear of losing, for instance, which is a common thread, and so on. So our course, and I'm going to offer you today a do-it-yourself course. You won't even need me. All these meditations, all these 7-minute meditations that I want you to take at the beginning of the day, they're all there ready to go for you. Okay, so your brain is like an iceberg, where the bottom part, and this is not a great iceberg because the bottom part should be about 90%. 90% of an iceberg is underwater. We only see the top 10%. And that's the same with the subconscious mind. The subconscious mind is where your decisions are controlled. Your conscious mind says things and tells truths and lies, but what you do reveals where your subconscious beliefs are, because that's what controls what happens. This is an actual picture of neural pathways. These thin lines are neural energy, literally energy pathways carrying thought. These are thought pathways. And what these neural pathways do is, if you get enough of them carrying the same thought, boy, I just lost in that trade, and I'm not sure, if this market is cooperating again today. And then this neural pathway, 2 minutes later, oh my gosh, I just heard something from CNBC that said that I'm not even looking in the right sector. And then another, 2 minutes later, oh my God, I just lost, and I would have lost in that trade if I took it. I'm glad I didn't take it. These neural pathways are creating this neural net. If you have enough neural pathways with the same energy message, with the same message, then it's going to form a neural net that says, I'm going to hesitate to pull the trigger no matter what, because I'm going to defend myself. So that when you get the stimulus from your trading plan to take a trade, Jousef tells you to take a trade, you hesitate. And the reason you hesitate is because you're operating on this neural pathway that says, be careful. And you've created the neural pathway by submitting these same similar thoughts based on what a reaction to a stimulus should be. So the way you counteract that, let me read this to you. A thought creates a neural pathway by slipping into an alpha brainwave state. And that's done really by just sitting in your chair and taking a few deep breaths. You may think it doesn't change you. You may think it's not doing anything. Take 3 slow deep breaths and relax. It will, even though you don't think it will. You'll drop into an alpha brainwave state. You can direct specific thoughts and create specific neural pathways. And if you create enough of them on your own by listening to the meditations that I'm going to give you, you'll have enough neural pathways to create a new neural net that will over a larger and more powerful neural net. You'll stop with these destructive ideas and thoughts, and you'll create a new neural net with the positive behavioral thoughts. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. I understand that losing is part of the overall winning in a valid trading plan. I understand that losses are part of the winning, and without the losses, there would be no winning. I follow my trading plan the way it's written. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. You put those thoughts in your head for 7 minutes, you'll start creating neural pathways that will start to build a neural net that will replace this one that you're now operating on. And all of a sudden, when you get the trade, and you'll know it when you get the stimulus to take the trade, and you put it on without hesitation, and you say, wow, I just put that on, I didn't even think about it. You're operating now on neural nets that work for you. Okay, I hope that short explanation was enough to show you how simple change can be, but you have to commit to 7 minutes a day. That's really all it takes. Okay, I want you to just write this down. This is the offer I'm making you. Go to thedisciplinedtrader.com. This is not a link, so you'll have to test your spelling capabilities. I know I did. Thedisciplinedtrader.com. When I have to give somebody my email address, I give them admin@thedisciplinedtrader.com. I constantly have to spell it for them. So I'm leaving it up there for you to absorb. And when you go there, that's our website, our main website. I want you to just scroll down just a hair, and you'll see this right here, this banner called Change. And this is where I put the offer for you. Manage your trading emotions. Getting pulled off your trading plan results in account cratering losses. Okay, all I want you to do is go to this site and then click on this button right here, See More. Okay, I knew a guy named Seymour, but click on this, See More. Okay, and what you'll come to is a page that has this video on it, that is a 9-minute video that describes what the disciplined trader peak performance formula is. It says some of the same things I just said, but it shows you the individual meditations that we have and how easy they are to access and play, and all the other bonuses and things that you get in the peak performance formula. We've renamed it. Years ago, we called it the Disciplined Trader Mastery Program, but that sounded like work. And people who've been using this for decades, I still use it. We have people using this literally for 15, 16 years. And they continue to just do a meditation, continue to support those positive beliefs with the 7-minute meditation, because you're building the negative neural pathways every time you turn on the TV. Okay, so I'm saying to you that just go to thedisciplinedtrader.com, click on See More, and you'll come to a page that will have this video. I just want you to watch this 9-minute video, and it tells you all you need to know about this do-it-yourself fast track to achieving mental emotion. It used to be, in the olden days, about 5 years ago, we phased it out, but we came out with a 12 CD set. And this is and now you're going to get it. It's all of this is digitally now offered to you. This doesn't exist anymore, okay? Except for we do have some of these journals left, these gold leaf journals. But this was a $2,000 product, and we sold them like hotcakes because this was the only thing, and it still is the only thing out there that helps traders with the mental and emotional conditioning and it proven to work. And it was so, and this is right now, we just digitized all this, and it's now in the program that I want you to, that I'm going to give to you here. And the idea here, though, is that this was just then. We've added so much to it. For instance, this didn't have the 208 4-minute drill for traders. Right now, in this program that you'll see that I'm giving you access to all of my 4-minute drill for traders, as well as all kinds of other things that I've developed over the years. But the most important thing that I want you to derive from this training are the subconscious trainings. I think you can see one right here, subconscious strength to pull the trigger. So go to the site, watch this 9-minute video, okay? What is the investment, okay? What is the investment to put yourself in the 10% of traders? What's it going to cost you to be in that 10% that actually make money? How much did let me ask you, how much your last unforced error cost you in trading, where you deleted a stop and you moved it down a little bit and it blowed through it anyway, or you chased a trade and it wound up backing up on you and you knew you shouldn't have done it. We call them unforced errors that's what we try to eliminate in tennis, and that's what I'm trying to eliminate for you here. If you can eliminate your unforced errors and just follow your trading plan, I've told you most of them are either pretty good or very good, and it doesn't matter, you'll make money on a pretty good trading plan, okay? You just have to eliminate the unforced errors. How much did your last one cost you? $100, $1,000? What did it cost you? How many accounts have you blown out since you started trading? I polled my traders, my list of traders at the time. It was about 80,000 traders, and the 40%, the response, this killed me. 40% had blown out 5 accounts or more, and another 28% blew out 3 accounts. So almost 70% blew out at least 3 accounts. So you're not alone, okay? What did that cost you? How willing are you to accept where you are in your trading effort? You know you have a pretty good plan if you can just follow it. How willing are you to accept where you are, who you are, and take responsibility for why you're not winning? How willing are you to invest in your mental and emotional capabilities so that you can be in the top 10%? How willing are you to spend a little money to do it? And I mean a little. And I say capabilities. I'm saying that you have the capability. You have just not brought it forward. You have allowed yourself to create neural nets that are working against you. Let us help you to reverse that, okay? 1 full year of access to the Disciplined Trader Peak Performance Formula is $397, $33 a month, $33 a month. Okay, so go to the Disciplined Trader, and I know we do. We give you, even, I say I think because I haven't seen anybody take advantage of it, at least in the last 2 years. I think it was a 60-day money-back guarantee, just for those that need a guarantee. Look, change what's between your ears, keep your good trading plan, and watch your fortunes change. That's the difference. Go to thedisciplinedtrader.com, find this banner. It's just right when you scroll down. Click on See More, okay? And you'll be taken to that page where the video is and a lot of other explanation. And be part of the Disciplined Trader group. And plus, we have a great Facebook group and so on, and we got all kinds of stuff going on. We even have hats and T-shirts and all kinds of things. So be part of our family. Be part of that 10%, okay? I want to thank you, Anna, for having me. I want to thank you, everybody, for allowing me to put the mirror in front of you and show you a little bit of love and attention that you can be the trader you want to be. You just have to take some action, okay? Thank you, everybody.
Thank you. Welcome, everybody. Sorry for the technical glitch there. Anybody who knows me knows that I am not a real technophile. Actually, I love technology. I'm just no good at it, so I don't know what that word would mean, but I have to add my Greek prefaces and all that kind of stuff. But anyway, hi. Okay, so I'm looking at the question box here. So if you want to type in anything for me, I can see you in the questions box or the chat box. And I see a lot of you were Oh, thank you. That's nice. Member says, hooray for Barry. Thank you. By the way, is that the name on your birth certificate? I don't know. I kind of wonder. But anyway, by the way, that was a great presentation about trading psychology. That is such an important part of trading. So many people focus on technical analysis and all of that. And of course, that's important, and that can turn you into a great technical analyst. But when you want to become a trader, then your mind is intersecting with the market, and you must. I mean, it is absolutely required. It is not even optional that you develop yourself. Well, as your self interacts with the market, you better be a developed self and disciplined self and well-disciplined trader. And so I just want to, add my acknowledgement to that and my support to that, because it is just, it's insurmountably important. It's not even an option. So you've got to do it one way or the other, or you will not be successful. It is that black and white. All right, now having covered that part of trading, I'm actually going to cover part of the technical analysis and just focus on a very, very small area, some setups that I use to look for explosive moves in the market. So a little bit about me here real quick. Bunch of old pictures, but my name is Barry Burns. I'm the owner and founder of Top Dog Trading. I am the author of Trend Trading for Dummies, the famous dummy series of books published by Wiley & Sons. I get Reader's Choice Awards from Stocks and Commodities Magazine. They do this wonderful survey every year where they ask their readers to vote on their favorite tools and things like that, and keep getting awards from my website and my courses. And by the way, if you voted for me, I want to really thank you for that. I've also helped other authors with their books, work with brokerage firms out there, work with the CME. Actually, I got trained at the CME, went back and did a seminar there for other traders. eSignal, I've written articles for them. Metastock, I've worked with them on their software. Eurex Exchange, did a presentation for them. It could go on and on and on. I've done presentations all over the world and traveling around before COVID, and now we do most of this online, of course. Got a great podcast. Check out my podcast. I love to give a lot of free things to the trading community and contribute. So check out my podcast. Just type in Top Dog Trading, whatever podcast platform you use. And again, YouTube. Got over 200 videos on YouTube now, well over 200. I've lost track. And check that out. Again, absolutely free. Just my gift to the trading community. So, of course, we got to make our lawyers happy, but I joke about that. But really, it's very important. If you think of these legal disclaimers, they are not just legalese. In fact, I think one of the worst things that happens is people just overlook them as being, oh, that's just legal jargon. No, the regulators are actually out there doing research and educating us on the hype. And I'm sure you all know there's a lot of hype around trading. So if you want to avoid that and stick to the truth, this is really your resource. Read all this legal stuff, because inside of there is what they're trying to do is protect us. And so read this stuff. A couple of the things real quickly is that trading is not suitable for all people. So if anybody tells you, oh, this, this trading technique or this indicator or whatever works for everybody, everybody's making money, that's not true. Please only use funds you can afford to lose. Trading is very, very risky. And even professional traders, even myself, we lose money from time to time. All information in this presentation is for educational purposes only. Please use this at your own risk. Take responsibility. This is general information only. So I'm not responsible for anything you may do with it, or if I made a mistake or whatever. And really important, past performance is not indicative of future results. And boy, I could unpack that one for the whole 40 minutes. But let's get to the topic of today. So the way that I identify markets that potentially have a big explosive move coming is through the use of cycles. Now, think of cycles as periods of time. So if you wonder what's the cycle stuff, you can substitute it for the phrase period of time. We have all kinds of different cycles. One of them would be seasonal or calendar cycles, cycles that appear during the same time every year. And, you know, retail cycles around Christmas, vacation cycles around the summer, you know, love cycles around Valentine's Day. All right. People who are selling things that have to do with love and romance and, you know, flowers, things like that. They probably do pretty darn good around February 14th. And then the rest of the year, you know, maybe not quite as well. Other days might be good too, but that's one day they can lock in on. Okay. So you got that in the market as well. And that really a great example of that in the markets would be commodities, soft commodities like agricultural products. So they sow in the summer, or they sow in the spring, reap in the fall. Okay, and that cycle is the same every single year. In fact, that's where futures contracts came from, with farmers who had to put out money in the spring, didn't make any money till the fall, and futures traders came along and said, hey, we will mitigate your risk during the summer when the crops could be destroyed and you lose your entire investment. But, you know, we want a little piece of the pie for mitigating your risk over that. So that's a great example of seasonal cycles or calendar cycles. Then you get your up-down cycles. This is what most people are used to thinking about: swing high, swing low, swing high, swing low, the oscillations in the market, the stair-step pattern of accumulation distribution. The third type of cycle, I wish I should do a whole webinar on this someday, order chaos cycles. Really, I don't think I've ever heard anyone talk about this except me, but people talk about these things in isolation. So for example, W.D. Gann talks about the market being orderly, and there's a lot of other people out there who will talk about the geometry of the market and how orderly it is mathematically. And then you've got other people who talk about chaos in the markets, and most notably there, you've got people who say, well, you know, the markets are perfectly efficient and you really can't make any money, you can't predict the future, and random walk down Wall Street would probably be the quintessential example of that. So I actually believe that we go between periods of time where the market is, I don't like to use the word predictable, but it is orderly, and then periods of time where it gets chaotic. And I would venture to say it's chaotic more than it is orderly, which is why overtrading is one of the cardinal sins of traders. And then you get your coupling and uncoupling. This has to do with sectors and industries and how they relate to each other. Sometimes they get aligned, sometimes they get unaligned. And then today I'm going to talk though about volatility cycles. So when we're looking for catching big moves early, a big move is by definition a market that has big volatility in it, a wide range over a short period of time. And so what I'm looking for is, I'll show you here some very specific examples, 3 specific examples today. I'm looking actually for the low volatility cycles. So I'm scanning, I'm doing the opposite of what most people do. Most people tend to use a scanner and look, they want to catch markets that are really moving. And so they say, oh, let's scan for a market that's making big moves. And the potential problem with that is that by the time their scanner identifies mathematically the big move over a period of time, that cycle, that period of time could be coming to an end. They could be catching the end of a high volatility cycle. Then they take the trade, and then the market comes back down again, and they say, God darn it, every time I catch one of these big moves, that's exactly when it stops. I think someone's looking over my shoulder. My broker is watching me. The market makers are watching me, and they're saying, all right, as soon as Pac-Man TJ gets in, let's turn this market around. As soon as Amit gets in, let's put on the brakes. As soon as Jeff gets in the market, all right, everybody, there's some red hotline to the exchanges, and they're like, okay, stop the market. And it feels like that. It's not really happening that way, but we can tend, and I've developed conspiracy theories like that back in the days of yore, because I thought it was uncanny how often I was wrong. But what I didn't understand back then was the natural ebb and flow of cycles of the market. So the volatility cycle is like this. And again, this is just a rough idea just to give you the big meta pattern of it, the concept. So high volatility is a wide range of price action in a shorter period of time. So it can conform, if you draw, outline it, look like a tall, narrow rectangle. Low volatility is where there's relatively less range and price action over a longer period of time, right? So high volatility cycle, low volatility cycle. All right, now some patterns that we can trade for these cycles. You got your Bollinger Band squeezes. You got your contracting channels, wedges, triangles, moving average convergences. All right, so these are three patterns: traditional charting, technical analysis, price patterns, where you can trade these volatility cycles. Now, the questions are, of course, well, which pattern should I trade? How early or late should I get into it? Which direction to trade in? Now, this is one of them that we get all the time, all right? You're in a triangle, looking for a triangle breakout, for example, and okay, well, which way is it going to break, up or down? Very important. And when exactly to enter and when exactly to exit them. So today I'm going to focus on three. I'm going to focus on moving average convergences. I'm going to focus on triangles, and I'm going to focus on one that is not talked about as much. In fact, actually, number 1 and 3 are not talked about as much. Detachment from equilibrium. All right, so let's start with number 1. Pattern number 1, moving average convergences. So these are the moving averages I use. You don't necessarily have to use these. I use the 15 EMA, 50 SMA, 100 SMA, and 200 SMA. The important part, whatever moving averages you choose to use, there is one thing that's very, very important, and that is use a relatively short-term and a relatively long-term moving average for this concept to take effect. And what we're looking for is very simple: the convergence of these 4 moving averages. So here we have all 4, and they're clustered together. Some people will call this a coiled spring. I've heard it called that by others, and that's a good term too. I like it. And actually, it's a really good term because it really gives you conceptually the concept here that the spring is coiled up and we're ready for it to what? Explode. So we're looking for them to come together. And by the way, what does that mean mathematically? Mathematically, what that really means is that over the last 15 bars, and again, you can use these, by the way, really important, you can use these on any time interval you want, this pattern. So I got a 3-minute chart up here. Why? I don't know, just had to put something up there. Okay, I could have easily have done this on a tick chart or a daily chart or a monthly chart or whatever. So when we talk about these periods, a period is, well, a bar relative to whatever time frame you've set there. So this is universal. And by the way, this one you can also use with stocks, forex, futures, commodities, options. That's what's so great about this particular pattern. It really is universal. No matter what you trade, you can use this pattern. So mathematically, what it means when we get these moving averages all clustered together here is that over the last 15 bars, 50 bars, 100 bars, 200 bars, the market has not made any significant directional move. That's what it means. And so, therefore, we have the contraction of volatility measured mathematically in that way. So we're looking for this, and then we look for that. Now, the key is, again, by the time this happens, too late. All right, that's where we get out. So there's several different places that you can get in on patterns like this. It's going to depend on your risk tolerance. As with many things, you can get in earlier, later, depending on your trading style, your psychological makeup, how aggressive or conservative you want to be in your trades. So generally, if you're going to be real aggressive consistently in your trading, you will get stopped out more. But when you are right, you will get a better risk-reward ratio. A little worse win-loss ratio, but if you learn how to manage those losses, you can keep them to be, fairly negligible. And well, I could go into a whole talk about how to do that. But anyway, if you're more conservative, that means you're going to wait later. The longer you wait, usually the worse entry you get. Not always, but these are just rules of thumb. So you get a better win-loss ratio, but not quite as good a risk-reward ratio. And that's all fine. Now, I know everybody and their parakeet says, well, I want both. I want a great win-loss ratio and a great risk-reward ratio on every single one of my trades. And that's great. And my daughter, well, she wants a pony, but she's not going to get that either. So those two those two ratios are almost diabolically opposed to each other. And I'm talking about over a huge sample of data. So sure, every once in a while you can point to, a textbook example and say, oh, look at this, I got the best of both worlds. Yeah, well, that's great. Try taking 1,000 trades and then show me. So anyway, that's just the nature of trading. That's okay. It's normal. Accept it and, learn to live with that. Most people's fantasies of trading are not real. And in fact, unfortunately, a lot of teachers are responsible for creating those fantasies because they want to, sell their wares, or they want to show you their stuff and have you buy it. And so they're going to always show you the best case scenario. By the way, I got nothing to sell you today. So I don't care. I'm just going to tell you the truth. In fact, literally at the end of my presentation, I got nothing for sale. I will not allow you to buy anything from me today. You could say, Barry, please, 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 I'm down on my knees. Sell me something, please. And I'll say, no, you cannot buy anything from me. Put your wallet and your purse in a lockbox. So, a little Al Gore reference there. But so yeah, I'm just gonna tell you the way it is. So, for example, let's look at this one. Okay, so here's a typical way this is taught. Typical way it's taught is to put in like a bracket over here. Get up above this high, below that low, and just bracket trade the puppy. That means that if it breaks above here, you buy. If it breaks below there, you sell. Well, look what happened in real life. And I love to show non-textbook examples. And even in my courses, I show examples that don't work. And I do that very intentionally. And it goes back to, well, the disciplined trader. It goes back to wanting to train your mind and train your eye, and then in relation to your mind, to visually get used to seeing patterns that don't work. If you take a course and the only thing they show your eye are perfect patterns, they're doing you a disservice psychologically, because then your mind will get attuned to that and get disappointed and think that something's wrong, when really, maybe when you're really trading, nothing is wrong. It's just like, oh, this is one that didn't work out. And that's normal. Maybe they don't work out, 2 out of 5 times. You can make a lot of money taking a loss on 2 out of 5 trades, a lot of money. And so you need to develop that awareness, that reality ahead of time, and train your mind to be accepting of that, and train yourself to also have a money management and risk management parameter in place for those situations. And then again, build up tolerance emotionally that, okay, that one didn't work out. That's cool. And by the way, maybe I better keep watching it, because maybe there'll be another entry. Okay. So anyway, just wanted to show you this. So boom, comes up and then comes back down. Oh, now you're going to be disappointed because, oh, it's just kind of meandering along here. All right. But then boom, oh, it goes back up. Hey, it hits a little resistance level. And you might think, oh, that's all we got. Nope, goes up again. Oh, pierced above here. Now here would be another thing. You say, well, let's wait for the next major resistance level, and let's trade the breakout of that. And so we get a fake out. Boy, I see these all the time. And then it comes all the way back down, and you could say, oh, god darn, look, came right back into that zone where we had the coiled spring or the moving average convergence. And here's where a lot of people would just give up on the trade and said, oh, didn't work, came right back into that zone. And then, boy, is this trading or what? As soon as it comes back into that neutral zone, kablambo, look at that big red bar, boom, and she goes to infinity and beyond, just when everybody gave up on the trade. In Top Dog Trading, this is what I actually teach a lot. I look for what I call them this, failed trades that make money. I'll say that again, failed trades that make money. So where everybody's looking to be successful is usually the wrong place to be successful. I mean, think of it this way. Once everybody learns to trade anything, everybody learns a pattern, that's exactly when it stops working for the masses. You've got to be, you can't follow the herd in trading. I think we all know that. And so now it's very hard to not follow the herd if you're a human being here today, because human beings, we are by nature social beings. And so it is our literal instinct to follow the herd. And not only that, we get rewarded for following the herd. We get emotionally rewarded. It gives us our greatest pleasures to be with our children, our family, our spouse. Well, hopefully your spouse. I don't know, these days, 50% of people get divorced. So find another spouse that, you know, it does give you the greatest pleasure in the world to be with her or him. And that's the challenge of trading. That's why I wrote an article for eSignal. Good trading must feel unnatural. Again, because you're going against your human herd instinct. And so at Top Talk Trading, what we do is we teach you how to find those places where the average trader, remember the average trader loses money, the average trader is now given up. They see a trade that they think has failed. But the reality is that's actually now the opportunity. That's the place to get in. Okay, and so this is the place to get in. Some of my students are here, and you will recognize this as what we call a second retrace in the trend, and it is a trend trade. And it is a fantastic trend trade because it has come out of this. It's gone right back into where most people are going to give up on it, and we understand, no, a trend has started, and they're just taking out all the weak hands. And that's what they're doing, taking out the weak hands of stops below here, stops below there, people who gave up on the trade. And so it's where all the money's shifting hands from the weak hands to the strong hands, as they say. And yes, that does happen. And yes, markets are manipulated. I hate to say that. I never used to say that because I just don't like, it sounds like a conspiracy theory. But unfortunately, I've seen that so much. And here's one of the reasons why it happens, by the way. It's not that, you know, the market makers, the specialists, the big money, the banks and all this. It's not that they hate us. It's nothing personal at all. It really has to do with they just want to buy low and sell high. It's as simple as that. And so if we get in before them and prices go up because we're buying, then that means they're getting in later, and that means they're paying more money. And so they got to drive prices down in order to get low prices, and that means taking out the orders that came in before them so that then we come back in after them. And again, that serves two purposes. Number one, as I just said, they get to buy low, but also when we come in after them, that's when it, you know, more orders coming in, more volume coming in, cranks it to the seventh heaven. All right. So anyway, there you go. Okay, let's move on to pattern numero dos. Zwei, ni, deux, that's French. Duo, that's Korean. That's right, I am pentilingual with the number 2, which, by the way, in case you didn't know, it's pretty darn impressive. Okay, just thought I'd tell you in case you didn't know. Yeah, you can tell I'm a dad. I've got 2 daughters, and that means that I am legally allowed to tell dumb dad jokes. I am officially certified, got my certificate on the wall. All right, back to seriousness. Here's how I trade triangles. So your average person will trade triangles one of 2 ways, either on the breakout. So we've drawn these, by the way, are technically not really trend lines. Most people call them trend lines. I don't use trend lines, by the way. Don't believe in them. They're against my technical analysis religion. But all we're doing here is connecting highs and lows. So we got lower highs, higher lows, and triangle formation. So 2 ways to trade it, typically taught the breakout. Okay, problem with the breakout here, and again, I like to show examples of that are not textbook. So if you brought the breakout, boom, comes down, goes up, comes down, makes a little bit of lower low, makes a higher high. Okay, and now this is confusing to the person who bought the breakout because they bought it down here, maybe somewhere down here, and now they're like, oh shoot, what do I do? The market, it looked like it was going to follow through, but then it didn't. It broke this higher high, and now maybe that's where they place their stop, and they're discouraged. They think, oh, it's going back to the apex. Messy, 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 messy. The other approach would be to trade what's called the throwback. which is different than a retrace. Retraces are in trends, throwbacks are in breakouts. So it comes down, and then the person who buys the throwback, they're intentionally saying, I don't want to deal with this kind of messiness, so therefore I wait for the market to come back up, and basically looking for it to retest somewhere around this line, and then go short. Well, again, the reason I use this example is because now both people are going to have problems, because if they bought this and they go short here, again, market goes up, and this is where they would typically place their protective stop. Now, if you trade the throwback, you give up something. And what you give up is that sometimes the market will just break out and go down, 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 down. Okay, and then the throwback trader, what they're sacrificing is those situations. And in those situations, psychologically, they have to wrestle with the idea that, well, gone darn it, I wish I would have just traded the breakout and I would have made money, but I didn't, and so I lost out, and they have trader's remorse. And so then maybe they'll start trading the breakouts, but then this kind of stuff happens, and so then they'll trade this. So again, the aggressive approach would be to trade the breakout. The more conservative approach would be to wait for the throwback. Again, some will work one time, some will work another time. Once you set your game plan, just stick with it and don't have trader's remorse. Just say, that's my game, that's what I'm playing, that's my angle. Now, neither one of them worked in this situation, and I don't do either one of those. So what I do is I actually trade inside the triangle. So what do I mean by trading inside the triangle? So I go short here. All right, now this is professional trading. This is aggressive. So this is the aggressive side of the spectrum for sure, not a conservative entry. The only reason that I'm able to do that, because if you notice, if I go short here, just looking at the price pattern, well, wait a minute, that is the swing high that actually forms the first lower high of the triangle. So it has not been confirmed yet. That's why it's an aggressive entry. The only reason that I can enter there is because I have a cycle indicator that when the cycle indicator gives me a certain pattern on it, then it is a super high probability cycle high. And it will give me that before the swing high is completed. So when, and that's not on every triangle, that's okay. But when I do get that cycle indicator confirmation of a cycle high, and we get a lower high like this, I'm very confident, high probability, I mean, seriously, 95% of the time, that's going to be a cycle high. Okay, that does not tell me anything about how far the market's going to move, but it does tell me that, yeah, that puppy right there is going to stay as a lower high. So then we trade it bar by bar. Now I've got some wiggle room. First of all, number one, I'm getting in earlier. So again, when I buy low, sell high, well, if you're going to short, you want to short high. And so I'm getting a better entry here than the person who trades the breakout or the person that trades the throwback. So I'm getting a better entry. Therefore, my risk reward ratio will be better just by virtue of the fact that I got in at a better price. And I don't have to worry about all of this monkey business. Okay, because I'm still in profit through all of this. Now, there's another really, really powerful thing here. Look at this. This is what I call concurrent setups, meaning we have two reasons to take this trade. And that is a very high probability trade when you have concurrent setup. So one setup is the triangle. The other setup is the head and shoulders. So we've got a left shoulder, a head, and a right shoulder. And that's what makes this concurrent setup. I could trade this based on it being a triangle, or I could trade it based on being a head and shoulders. And it's both. It's two trade setups in one. So I love these concurrent setups because now there's two reasons to trade it. By the way, the only reason is the head and shoulders, very important, is because, and you see I've got my wave counts here. These are actually not Elliott waves. These are, well, for lack of a better term, I call them Berry waves. They're more objective and rule-based. They're mathematically based. We don't change the wave count on these and make sure the market only puts in 5 waves. No, you can get 30 Berry waves in a trend, but it's rare. The average is 5. So we have a statistical norm based on lots of sample data as to what the average will be. So a head and shoulders only occurs at the end of a trend. So a head and shoulders is not just a high, a higher high, and a lower high. That is not enough for a head and shoulders. The dollars are in the details. True head and shoulders is a trend reversal pattern. So it has to be near the end. It can't happen before wave 5, for example. Okay. All right. Oh boy, time is going by fast. 9 minutes. All right, we're gonna make it. We're gonna make it. So pattern number 3, this one is especially for day traders. Detachment from equilibrium. So the two tools I use here, well, actually one tool, is floor trader pivots. So I just use the traditional classic formula, by the way. If you have another formula you prefer, that's fine. So what we're doing is equilibrium is defined as the pivot point, or the central pivot, and yesterday's close. YC stands for yesterday's close. All right, so we look for those two levels. And so here you can actually do this on your charts if you want to, but I highlight it with yellow. And that is our equilibrium point for the day. That'll be the equilibrium point all day long. So the pivot point will be put in at the open, and yesterday's close, of course, is actually put in at yesterday's close. So right out of the open, at the open of the market, that zone is there for you, and you can start trading it right away. So pretty interesting. We actually opened above the zone, came right into it. All right, comes back down below it. Boy, I see this stuff all the time. Here's again, traditional trade that I was taught way back in the olden days. I'm old, I'm 62, so that's right. So when me and the dinosaurs were trading, they used to tell me, oh, look for a break of yesterday's low or yesterday's high. That will determine a bullish or bearish market for the rest of the day. And there was a time when that actually worked, kind of okay. More times than not. Not so much anymore. Again, everybody in their parakeet knows this, has been taught it, and therefore it doesn't work anymore. So there we go. You get your breakout of yesterday's low, and this is again typical. And it's like, oh, nope, psych, didn't work. Came back up above yesterday's low. Then it goes down again. People are like, oh, this is the time it's going to work. Now, finally, it's going to work. And the market says, really, you think so? Oh, okay, cool. That's awesome that you think that. It goes back up. All right. So most traditional stuff just doesn't work anymore. Okay. I never trade the breakout, so the previous day's high or low. There's got to be something else. If I am trading it, it's just coincidence because there's something else going on. But it's never purely because we broke the previous day's high or low. Everybody and their gerbil sees yesterday high and low. They're watching those levels like a hawk, and they're not going to make it that easy for you. Okay, because they don't want to make money for you. Isn't that horrible? Nobody in the market is trying to help you make money. Everybody's trying to make money for themselves. I know. Those people are very selfish. So what we do anyway, and what I do with this is I wait for all this monkey business to happen. Okay, cool, fine. Wait for it to come back into equilibrium. Now, again, we're getting in early. This is aggressive. And I don't trade the breakout of the high or the low. I'm looking, now my ultimate goal is, yeah, I do want it to break yesterday's low, but I'm going to get in before it breaks yesterday's low when it comes back into equilibrium, when most traders have now given up and say, market's right back where it started from, right back into no man's land, right back into neutral zone. And I'm saying, great, that's where the opportunity is, because this is not where the average trader is looking for it. So I actually get in here and look, again, breaks yesterday's low, just kind of wiggles around here. And as it does, I'm like, no problem, it's cool. And look how well by the way, mid pivots. A lot of people don't use mid pivots. I really am a strong believer in mid pivots, especially when the previous day's range was narrow. So that's what that is. It's halfway between S1 and S2, S1, S2. Goes right to that, boom, goes down to S2. And if we finish out the day, yeah, it goes down to the center of the earth and swirls around in the magma. Big, 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 big winner. And it all came out of what? Contraction, another type of contraction period of time. So the important patterns here are, well, what are the patterns to trade? I gave you 3. There's more than 3. Which direction to trade? This is where, again, don't just, please, by the way, got to really say this. Do not trade these patterns without more information. Do not go and just trade what I've shared with you today. Don't throw money into the market just based on what I shared with you today. You will lose money if you do that. You need more information. And one of the things you need is to be able to measure momentum of money flow. When we're going to see the markets really break one way or the other, momentum is the key, the strength. And momentum is literally the velocity of the orders going through the exchange and volume. And we want to see big money volume there. That can't turn around so fast. Early or late, here's where my timing indicator comes in. I mentioned my cycle indicator. I'll show you how to get that for free. And so here it is. Here's my last slide. So I promised I didn't have anything to sell you, but I do have stuff to give you. There's my email address, by the way, since we're just about out of time. You want to have any questions for me, and I actually have to go right after this. I literally have an appointment at 11 o'clock California time, so I don't have time to stay over. But feel free to send me any questions you might have, Barry@topdogtrading.com. I'm going to give you one of my free trade strategies, and this does include everything you need to trade it. So it's a little mini course. You get 5 videos, interactive quiz, get a little feedback loop going there so that you make sure after you go through the quizzes, you're locked in and you know exactly what the rules are. And my favorite trade, one of my favorite trade setups is the rubber band trade. This is the opposite of a trend trade. Again, why does it work? Well, it's the opposite of what most people do. Everybody is looking for trends. Trends can be great. I do make money with trend trades. The rubber band trade is essentially failed trends. And boy, you can make so much money when you trade failed trades, setups. Instead of losing money on them, let's make money on them. Again, the whole concept of failed trades that make money. And I'm going to give you one right there. And my cycle indicator, there's a whole nother like 45-minute recording where I share with you how to set that up. It's a common indicator, by the way. When I call it the cycle indicator, it's not an indicator you need to import or program or anything like that. It's a common indicator on any charting platform. We just modify it and turn it into a timing indicator. So I show you exactly how to do that. And you get it all at topdogtrading.com/free. So that's it. I finished on time. Very proud of myself for doing that because I know we have great other great speakers here. So yeah, that's it. I'm just typing into the chat box. Top Dog Trading. That's funny. Trader says, "Hey youngster, move over. I'm 68." That's funny. Well, it's all relative.
Hello traders, this is Alla from Fibonacci Trading Institute. In this webinar, I will be teaching you how to become top 1% with Alpha Fibonacci system. But first, I would like to remind you, very important, required disclaimer. Every single thing I do in this webinar is to teach and empower you. Nothing constitutes a financial advice. All the software, all the performance shown as is without any guarantees, and all testimonials from students and graduates believed to be true. No one had ever been paid for their testimonials. I also would like to encourage you highly to sign up for the trading room invitation on our website. If you would like to get on our mailing list, please sign up for the invitation and you will witness the power of the system in the live markets in our trading room by simply coming to fibinstitute.com. Let's start. In this webinar, we will cover how to trade as top 1% does, how hedge fund traders prepare and trade on all instruments, and how hedge fund traders trade stocks, futures, commodities, cryptocurrencies, forex, any instrument with Alpha Fibonacci system, and how most importantly you can trade like a hedge fund trader with Alpha Fibonacci system. Briefly about myself, I taught this morning for the previous 4 hours, our global community of traders. I've been doing so since 2011. I developed proprietary alpha Fibonacci system that is traded globally by institutions, by hedge fund firms, and by retail traders since 2011. Since 2008, when I developed our first proprietary strategy, I keep developing proprietary systems with more than 32 strategies and various software. 2011, I founded Fibonacci Trading Institute, Fibonacci Trading Podcast channel. Our global community currently in more than 50 countries, where traders of all levels, all backgrounds, trading alpha Fibonacci system you will see in this webinar. I'm very proud of what I developed, and I'm very proud of what I will show you and teach you now. This is our community, and this is the reason I live and breathe what I do. Jason just flew into California to meet with me. Emmanuel brought his beautiful wife Jennifer to the course. Richard, you can listen to his podcast on our website. Sam put his daughter through Harvard trading alpha Fibonacci system. William, my dearest friend for life. Victor, hedge fund manager in Switzerland. This is our global community of traders who think, live, and breathe as top 1% does. Trading this. This is proprietary system. This is what I've been teaching for the last 11 years. Look at this chart and ask yourself a question. Have you been riding bullish train during this extreme crisis, or have you been shorting the market? I just came back from Hamptons, where the world is absolutely insane, where rentals in millions of dollars. Top 1% loves crisis for one simple reason. Buying the bottom is a brilliant thing to do. Crisis is opportunity for top 1%. And when you understand this, you also understand why yacht sales are booming. Top 1% not afraid of crisis. Top 1% knows very, very well that buying the bottom and enjoying phenomenal run, biggest bullish rally in more than 100 years, is a stunning reminder. Exact same people who own news channels, exact same people who spreading panic and negativity, buying the market. With the power of alpha Fibonacci system, you know this many months in advance. Here's the system before the crash at critical institutional reversal zone. Many months in advance, you understand that 2200 will be institutional entry point. So when market crashing and selling off, and institutions already buying on the way down, you are very well prepared. Because when on March 23rd, this key level is reached, you are riding market with Goldman, with BlackRock, with JP Morgan. You are never, ever shorting into institutional support. Country in lockdown, everyone in panic. Multi-million and multi-billion dollar positions buying everything. As intelligent strategic trader, you are trading with them. You are not trading against them. This is what your day trading chart look like in the month of March when rally starting at 2200 level. Stunning, spectacular. With alpha Fibonacci system, you know this. Hours, days, weeks, months, and years in advance. All depends the chart you trade. Price is no longer 2200 level. This morning on August 12th, price doubled. Biggest run for top 1% remains intact. Anyone seeing crisis on this chart? How many shorts have you taken this year? Have you been trading with quality, or have you been standing in front of Goldman bullish train? In 2020, every single day we discussed buying at key alpha Fibonacci levels is a brilliant thing to do. In 2020, we did not see any crisis. And when price this time around reached institutional support level, market did not crash. Institutions added to positions. And that's where we are today, because rally remains intact. And this should serve as a very powerful lesson. Trading pure price is a key. With Alpha Fibonacci system, you know months ahead where institutions will be taking position. This is a top day trading instrument in US, S&P E-mini future. With Alpha Fibonacci system, it's pure and clean. This is a system right now in front of you. Bold green line means look to buy. What is the problem? We're no longer at support. We are at historical high. This is the basics of the system in front of you right now. This is what you can trade on any instrument. And when you do, the sky's as a limit. You're buying the bottom and you know how to scale out. And this is what intelligent trader trades on any instrument. Every trader different account, every trader different background. Hedge fund traders do not chase indicators. Hedge fund traders do not chase cheap systems. Cheap systems produce cheap results. If something works, it's worth paying for. Hedge fund traders trade indicator free. So if you want to become top 1%, you need to trade pure price. It is that simple. Every single instrument developed after price made a move. So if I bring to your attention right now the most basic part, this is what should open your eyes on indicators you use. This is S&P mini future from the class I just finished teaching. This is what every single student starts with. If I change this chart to 5, chart looks exactly the same. If you can trade 5, you can trade 60. But if I take you to pound dollar, shocker, it's exactly the same. Price is price everywhere. But if I take you to weekly Apple, it's exactly the same. Why in the world would anyone block the price? Tell me. Apple looks exactly as 5-minute S&P. When you master this, you can trade any instrument you choose. And it doesn't matter if it's Bitcoin or Tesla or Apple or S&P. It is all the same. And this is a core of the system. And this is what I recognized very, very clearly in 2008. So when you focus on pure price, you can trade anything you choose. And you can buy markets at the bottom with institutions. Because if you want to become top 1%, you do not trade little charts by itself. Never, ever, ever. Because top 1%, when they take million and billion dollar positions, it takes days, weeks, and months to get into position. It doesn't come from 1 minute or 5-minute chart, but you take this to your advantage. You're riding their power. So if your account is micro, this is the most important chart. This is a chart you pay attention to this year. This chart, when you witness the most breathtaking rally continuing on S&P while the country in a full lockdown. This is a stunning reminder. Ride the power with multi billion-dollar positions and never, ever trade against them. So here's a few of my favorite examples this year that students globally trade. Here's Bitcoin traders, very popular, extremely volatile instrument. With the power of Alpha Fibonacci system, you know and understand and expect crash on Bitcoin from reversal zone. So when Bitcoin continues higher up, you understand very well it's a quiet before the storm and 44,000 holding the key on crash on Bitcoin. So when Bitcoin crashes 65%, you are brilliant, intelligent trader. You did not buy reversal zone. You are very well prepared to buy the bottom. Bitcoin skyrocketed, collapsing from 65 to 29 and skyrocketing while I was on vacation. This is the power of the system. This is what I've been teaching for the last 11 years. No speculation here, none are present. Pure strategic, intelligent, price for entry and alpha Fibonacci for exits. Alpha Fibonacci system is an indicator-free system. It's a complete semi-automated system with multi-market scanner and proprietary Alpha Fibonacci software for Ninja 8. You can also trade system on any platform, any instrument. Sierra charts, MT4, interactive brokers, any chart you choose. Alpha Fibonacci system is traded on. No software required. So here's, for example, system with a software in the current markets. This is how pure system is. What do you see on this chart? Pure entry, pure stop, pure targets. Indicators not blocking your vision. You are not surprised. Sellers are weak. This is a counter trend move. This identifies bearish weakness. It takes many hours for price to collapse to drastically lower levels. Why? Simple. When institutions buying the markets, why in the world would you touch any shorts? You would ride bullish power with them. You would look for drastically higher quality trade. You would buy ultimate pullbacks at the ultimate low. And when that plays out, you enjoy the ride. It's a stress-free trading on any instrument you choose, as you will see throughout this webinar. So this is what Richard does. Richard, retired physical therapist, came to the course after losing a fortune, after struggling for many years. So please listen to Richard's podcast on website where he shares his journey. So when Richard made an effort and doubled his demo account, only then he started trading live. So demo account on November 9th, from 50K to 100K with market replay, only then he started trading live. December 7th, his funds 3,600. On January 22nd, his funds 11,500. Listen to what Richard shares, what he shared in the month of February. His account up to 18,000, April 37,000. Phenomenal, breathtaking effort. Richard thinks and trades as top 1% does. No speculation, pure price for entry and alpha Fibonacci for exits. This is a trade Richard would choose. This is a power. Richard trades with institutions, not against them. This is decision you make every single day. And where does the price collapse from? There is no surprise. It reached the reversal zone ultimate collapse. Pure entry, pure stop, pure targets. Intelligent, strategic trading. And when you come to the website, after you join us in the trading room, you can listen to Richard's podcast and many other traders here on our podcast channel. So this is the power of the system, traders. Pure price, rising institutional levels, institutional zones. Can you trade S&P mini future? Of course you can. Can you trade Bitcoin, option stocks? Of course you can. It is strategic, precise, institutional trend system that removes speculation and allows trader to trade markets as strategic alpha Fibonacci chess on all instruments. System consists of only two components, indicator free price and alpha Fibonacci retracements. Here is a couple of my favorite examples. Here's Apple at the crucial alpha Fibonacci support. I presented the biggest hedge fund convention, but Apple comes out with the worst earnings in 13 years in 2015. What do I say? What is more important? Is it worst earnings or is it this support? Of course, this support holding the key. Apple doubles in value, despite worst earnings in 13 years. Many months in advance, you know where next level will be. Many months in advance, you know where Apple would crash and burn from. So when Apple reaches reversal zone, you understand this support holding the key. Do you remember Bitcoin this year? This is Apple 2018. Many months ahead, you know where to buy Apple at the bottom at 140. So when Apple in free fall, there is no surprise, all precise. And this is what price does on any instrument you choose to trade. When you use Alpha Fibonacci system, you can trade Apple, Bitcoin, S&P. Price is price everywhere. And that remains the key. So if you choose 1 minute, 5 minutes, 15, of course you can, as long as you're riding institutional power, institutional trading range. But if you trade against them and you touched any shorts, it's not a good idea. So here's a system right now in the live markets. This is what I was teaching in the live class. The power of identifying all of this in advance. Here we are since August 3rd. This is institutional entry points. And you know these entry points weeks and months ahead. But if I click on this chart and I take you back to August 1st, what do you see on this chart? You know all of this in advance. This is all the details in Thursday live class and modules 3 and 4. And it doesn't matter if you trade 5 minutes. It doesn't matter if you trade 6 minutes. It doesn't matter if you trade range chart or tick chart. You know this in advance. This is strategic intelligent trading. And if I take you forward to August 5th, these are the markets. Price is heading higher, and you knew this in advance. So if I bring to your attention the events of this week, this is intelligent trading. This is where markets skyrocketed from again and again and again. This is present in the trading room for a long time. This is a reason system traded globally. If you can trade one, you can trade them all. Software for Ninja 8 is not required. So when I receive emails, thousands of emails from all over the world, this is how traders trade the system. This is what matters. This holding the key. Calm, strategic, intelligent trading. Would you like to trade options as Sue does? Of course you can. Again, listen on our podcast channel. When you come to the website, podcasts from traders all over the world, with their journeys, with their stories, how they think and trade as hedge fund traders do. You can trade any account you choose. It is absolutely your choice. But as long as you think and trade as institutional trader does, you are always trading with power. You are never trading with weakness. So please understand this is a crucial part, is a key of the alpha Fibonacci system. And that's playing out in front of you right now. So if I convert this chart to 5, what do you see? Is anyone surprised where buyers came from? Should not be. This is a chart present in the trading room for days. This is the reason, students, my dearest friends for life, I simply ask you to make an effort and identify what you want to trade. CEO is a legend, as he shares constantly in the trading room. Trading with those powerful institutional levels is going with the market flow of the smart money. Being able to draw these levels manually, as taught in the course, is winning a battle before it's even fought. We already reviewed Apple. We're far ahead. Because if you prepare and strategize with institutional power, ask yourself a question. What would your trading be if you knew in advance were institutions taking positions? You would simply prepare, relax and exhale. You will stop speculating. You will stop panicking. You will stop chasing junky trades. You would stop trading against multi-million and multi-billion dollar positions, no matter what crisis is next. This is how pure system is on gold. You're looking at it. Traders trading this everywhere on different accounts on different time frames. This is gold on little day trading chart. This is how pure system is. Precise entry, precise stop, precise target. But if I bring to your attention institutional chart with institutional alpha Fibonacci system, this is key level on gold in front of you today. But if I take you back before the gold crash and before the gold reversal, take a look what played out. Shall we go all the way to July 2020 on institutional chart? This is what system look like. This is how you exhale and strategize. Here's July on gold last year, July 1. My goodness, price is heading higher. Do not enter into 2100 level. Be prepared for spectacular reversal. This plays out 80+% of the time. This is what I'm teaching in the live class for the last 11 years. And when the price is heading higher, you're enjoying your profits if you're investing in gold. You know extremely well where to exit. You know extremely well what identifies sell-off with rules of the alpha Fibonacci system. This morning, we're dealing with institutional reversal that again been present in the trading room for years. And that's the difference. Do you want to invest long-term or do you want to day trade? As long as you day trade with the power of institutions, you are in excellent shape. And that's gold. for the last year and a half on long-term institutional chart before price skyrocketed and before price crashed. And that's what every single trader enjoys on any instrument. Choice is yours. What to do with your position on gold? You must obey alpha Fibonacci rules. There is no surprise, all precise. Where gold skyrocketed from? In April and today. That's it. Choice is yours. Are you investing long term or are you utilizing day trading chart? The only difference, how long you will hold the position. So when David comes to the course, he clearly instantly see within seconds the quality of the system. And as he shares on his podcast, as you can hear on our podcast channel, prior he was averaging 4 to 8 points per day, but ever since joining the course, his results improved tremendously. He's trading it all. Dow 4080 points. He's also trading oil. He's also trading gold at the open and S&P. And that's traders' personal individual choice. So if hedge fund trader trades with institutional alpha Fibonacci precision, with institutional alpha Fibonacci rules, trader focuses only on quality trades, never wasting time staring at the screen, never searching for trades for hours, never ever chasing the markets. We already reviewed the Bitcoin, and that's very important part. Is it Apple? Is it S&P? Is it Bitcoin? Is it gold? All applies. So when Steve, MD, my dearest friend for life, took private mentoring course in 2018, he was buying Bitcoin at the bottom. So when he's sending me email in June sharing he exited Bitcoin before the crash, while all the other doctors were buying Bitcoin at 60, this is intelligent quality trader who is trading also equities, commodities, gold and silver. Because if you can trade one, you can trade them all with alpha Fibonacci system. Here's Amazon since 2018. Amazon reaches critical mid-trend, stuck and frozen. Many months in advance, you know where Amazon would crash and burn from. 2000 is reversal zone. It doesn't matter how spectacular the earnings are, Amazon in free fall at 2000 level. And Amazon sold off $700 plus per share and continued doing so 3 times within 3 years, crashing and burning despite excellent earnings from alpha Fibonacci reversal zone. But you also know where to buy the bottom. You're not buying 2000, you're buying 1300 level. Exact same thing on any instrument. Choice is yours. Is it gold or is it Amazon or is it Apple? Jennifer, her husband Emmanuel brought her to the course. Listen to Emmanuel's podcast. So Jennifer keeps updating me. In July, she sent the email sharing that she's trading NASDAQ and S&P, mom with 2 little babies at home. She only trades with quality, as intelligent trader does. You've seen Jennifer's and Emmanuel's picture on the front page of webinar. And that's the reason I live and breathe what I do. Because alpha Fibonacci traders manage crisis just fine. Thinking and trading with quality, riding the power of institutional train. You do not need cheap indicators. So if you want to trade Dow off course you can, as David does. But if you would like to trade oil, as our incredible trade in Saudi Arabia does, and many traders, hedge fund managers do, here's oil with alpha Fibonacci system since 2016, and you will see what happened yesterday during oil news. 2016, oil skyrocketing from the bottom at ultimate entry point, correct? As S&P had done on August 3rd. So when oil skyrocketing in 2018 doubles in value, you know many months in advance where oil would crash from 77 level, exactly the same as 2000 on Amazon. Exactly the same as 216 on Apple in 2018. So when oil in free fall, you know many months in advance that 55 is lifeline on oil. 55 is out. Skip forward 2 years. Historical event is on. You are looking at numbers that showing reversal zone at negative. Has anyone seen negative numbers on futures? Apparently it exists. I have never seen this in 11 years of doing this. We're looking in shock when oil continue collapsing, staging historical event, skyrocketing from negative number. Have you bought oil at the bottom with institutions? You can trade oil stocks, options, various derivatives. With Alpha Fibonacci system, you know where the bottom is many, many months ahead. So when Mustafa sending me this email informing me that he's quitting his job because he became so profitable with Alpha Fibonacci system, this is what Saudi trader trades. This is what all the stocks in Saudi Arabia based on. But hedge fund manager in US trading very different account, buying oil at 49. Every trader different time frame. Every trader different journey. Every trader different chart. You decide. Alpha Fibonacci system applies. Here's oil this morning. Here's the rally that started in 2020. This is institutional support in front of you. Have you seen what's been playing out during oil news? Have you been witnessing how oil crashes during bullish news and how oil skyrockets during bearish news? In case you miss the events, let me remind you. This is the events in our trading room yesterday morning after oil news. I'm going to take you back so you can see in case you missed. Going back to day before the event. So today is August 12th. Let's go to August 10th. Here's a system. This is what your chart look like. You know well before oil news that this is critical support 67 level as intelligent strategic alpha Fibonacci trader. So how is it possible that oil comes out with a negative news, but oil skyrocketing? This is what played out on August 11th. In our trading room, video will be posted on our YouTube channel. Negative news does not mean a thing when alpha Fibonacci support is present. As you saw on Apple, on Bitcoin, on Amazon, on any instrument, alpha Fibonacci system overrides negative news again and again and again. So if I take you back on oil again and again and again, I love to do this because instantly during news, you see how crucial price and alpha Fibonacci is. Here is July 28th, traders. Look at this chart, positive number, July 28th, 7:30 a.m. my time. I'm taking you back to July 27, before bullish news. Here's oil on July 27. Bullish rally overextended. Intelligent trader knows many hours and days ahead. This is not the place to buy oil. This is exhaustion levels. Bullish news doesn't mean a thing when alpha Fibonacci reversal zone is present. Here's oil during bullish news at reversal zone. This is what plays out. Day after on oil. Start selling off. This is a key. This is holding the crush. Ever since bullish news, oil sold off and crashed and collapsed completely. How many points? From 74 all the way to 65. If trading on the news worked, every person on the planet would be Bill Gates. It does not. What works is price and your brilliant, intelligent mind. You want to become top 1%, you need to stop doing what majority does. You must identify your trading range prior to your trade. Every single day, trading range varies. This is the most important part. You paying attention to news due to volatility only. When support is present, no matter how bearish news is, you never, ever short into. When bullish news plays out, but critical alpha Fibonacci reversal zone is present, you never, ever buy into. Shall we look on Tesla with alpha Fibonacci system in the last few years? Here's Tesla. One moment. We have only a few minutes left. I need to start getting wrap up. I love what I do, guys. I have so much information I would love to share. I can talk for the next 50 days. So let's start wrapping up. Here's a final example of Tesla. Here's Tesla traders. This chart present in the room for years. 388 is reversal zone on Tesla. 255 key alpha Fibonacci support. Tesla continued being stuck at these levels for years. No matter how bullish news is, Tesla cannot break through this level. No matter how bearish news, Tesla cannot crash through 255 level. This is how simple system is. This is all you have to remember. If you can trade price and you can trade alpha Fibonacci retracements, this is all you will ever need. This is where Tesla skyrocketed from ultimate bottom as a crucial, critical buy point. And when you understand that, you are trading with very little stress, as long as you obey the rules of alpha Fibonacci system. As William, my dearest friend for life, retired attorney in Palm Beach does, as he shares, the cost of this program is the best investment that I have ever made. William got rid of his bad habits. He's focusing only on quality trade. So if you decide to trade Forex, of course you can. Absolutely, choice is yours. Here's example on pound dollar. Pound in free fall after breaking critical institutional support that pound respected for years. Many years ahead, you know that 111 institutional buy point on pound. How is it possible? Pound skyrocketing during Brexit? Is it really possible? Of course. Alpha Fibonacci reversal zone overrides horrific event in Britain. And that's how intelligent strategic traders trade on all instruments. So when S&P is asleep, can you trade Forex? Absolutely. Students share every single day various different instruments you trade. It's absolutely your personal choice. So when Theo moves to Forex and shares what he trades, of course you can. But if Boards prefers to trade NASDAQ, absolutely. And that's what traders keep emailing me over the years, time and time again. It is your choice what you want to trade. Simply make an effort. And when you do, the skies are the limit. So please sign up for the trading room invitation if you would like to receive email from us. And please review the information on the website. As you will see, this is a system traded globally by traders of all levels, retail, institutional, hedge fund managers trading on all instruments. Listen to podcasts, view emails students send, and view what students share about course, and view movies students make about their lives. And choose from option appropriate for you. Due to current crisis, we are offering the biggest discount ever, up to 5,000 in savings for private mentoring. It is 4 months program with lifetime system and software for Ninja 8. It includes all group classes, video library, and all modules. Live classes, trading room included. But if you prefer group course, of course it's available to you. Again, it's a lifetime system for any platform, any instrument, any account. You can trade stocks, you can trade options, you can trade futures. Software for Ninja 8. Many traders using software for Ninja 8, but if you would like to place trades on different account, on different system, on different platform, of course you can. Any questions for me? Do not hesitate to contact me. 925-257-4298. Thank you, traders, so much. It's been my joy and pleasure being with you. So I hope you will review all the information on the website, because I look forward to your podcast. I look forward to your email. I look forward to see you trading with quality, as our traders do globally since 2011. Thank you so much, everyone. It's been my joy and pleasure being with you. Any questions, do not hesitate to reach out. And again, please sign up for the trading room invitation. If you would like to continue receiving emails from us, you need to do this.